Welcome to Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Stassi. We have breaking news on January inflation. The consumer price index rising 0.5%, 0.5% month over month. That is right in line with estimates. On the core level, rising 0.4%. That too right in line with what analysts had been estimating. Now, on a year-over-year basis, inflation actually rose more, 6.4% than analysts had anticipated. It's still a little bit of a deceleration from the prior month, and core year over year rising 5.6%. So largely we are seeing these numbers come in line with estimates here. They do represent a reacceleration, right, from what we saw in December. And this increase on the headline is the most in 3 months' time, that 0.5% increase month over month. That core gain, by the way, 0.4%, is the average gain that we've seen over the past 6 months. So not really a change there. Not seeing the disinflation necessarily, right, guys, that the Federal Reserve has been looking for. But, this is being seen by some economists as an anomaly, right, that we are going to see the pace of inflation start to slow more as 2023 goes on.
Yeah, one area that I've been keeping a close eye on is transportation services, and then more broadly within that, some of the mobility elements within a CPI report like this. The month over month move that we actually saw some declines month over month in the index for used cars and trucks. That fell 1.9% during January. That continues this recent downward trend that we've been tracking. And then also airline fares, as we've continued to have discussions with CEOs of Expedia, like you guys had yesterday, talking about what this demand profile is holding up like for travelers. It begs the larger question of where fares are continuing to move right now. The index for airline fares actually fell 2.1% over the month there. So some improvement on the price front, at least for consumers right now.
And interesting to see the futures come back, really trying to figure out what this means for the Federal Reserve. I'm locked in on egg prices. Egg prices, something we've been tracking here for about a year and a half. Up 8.5%. So the gains, if you're looking for disinflation, that is probably the theme of the morning as it pertains to the CPI. You did see a little bit in egg prices, but still items for everyday essentials, household goods remain very, very high. And we also saw that in that earnings release this morning from Coca-Cola. I know they outlined a slowing pace of inflation in their guidance for this year. I have a story on our homepage now on that, but still the rate of increases are high on everyday staples, which ultimately raises the question, what is the true state of the health of the consumer and how much money do they have left to spend right now?
Spending on staples, prices on staples are still high, but they are actually decelerating a little bit. I'm looking at food at home prices, which rose 0.4% after a 0.5% gain in December and a 0.6% gain in November. They're still going up, to be clear. They're just going up by a smaller amount. A couple of other things that I want to mention about this CPI report. First of all, it has now been rebalanced. The percentage that goes into the overall calculation that comes from owner's equivalent rent, which is sort of an estimate of rent that some economists do not like, but it's what the Fed uses. It is now about a quarter of the total calculation. The weighting of used car and new car prices is going down in this, by the way. And by the way, used car prices fell 1.9% month over month. That's good news. They were expected to reaccelerate last month. So that's an interesting figure as well when we're talking about this rebalancing. One more thing to note about the rebalancing, the BLS used to do this every 2 years, this rebalancing, this reweighting. Now they're doing it every year. So this is something you can look for every January.
Yeah, just lastly here, one of the other core discretionary categories, and discretionary but necessity, apparel here. I've been keeping close tabs on that because I think even as we look across some of the purchasing trends in footwear and apparel, consumers right now, they're continuing to see some of those prices increase slightly in apparel. Looked like it was up by about 0.8% in this most recent month here. So whether you're spending up to get those new Jordans or just trying to get a basic white tee to make sure that you can get that overshirt on, whatever your fashion preferences look like, paying just a little bit more there still.
If you are setting up your trading day, I think the early read is this. We're seeing futures really, I think, accelerate a little bit off of these numbers. Yes, signs of disinflation feeding into that Jerome Powell narrative. We heard from him at that last Fed meeting. But also, to your point, Julie, prices still remain elevated, which, again, should raise the question, does the Fed ultimately pivot? Wildly unclear, but still interesting CPI numbers.
Interesting indeed. We're going to keep covering all of this and be back with you. In the meantime, as Saz mentioned, seeing futures higher after this report.
Brian Zazia, Yahoo Finance here with Brad Smith, and we're getting ready for our latest After the Call. It is Airbnb.
It is indeed Airbnb, a great company that perhaps you've rented one or two homes from in the past.
Airbnb stock up 35% year to date, one of the hottest stocks in the entire market. Brad, I know we're going to be on this conference call. Everybody's excited about the numbers, but I'm excited to hear who founder Brian Chesky has been renting his very expensive San Francisco house to. He's been doing this for months. I haven't rented it yet, Brad. I haven't rented it.
I know you're a fan of glamping. That's why you haven't rented it just yet. I'm going to be looking to see where that demand is holding up among consumers right now.
After the Call, Yahoo Finance homepage and YouTube coming up. It was a mixed quarter for Expedia, with the travel booking platform citing struggles from severe weather, which impacted demand and dragged down the company's momentum. Expedia did note that demand bounced back in January. Very important there. Expedia Group CEO Peter Kern joins us now. Peter, always nice to get some time with you. Let's lock in on January. What did you see trend-wise? And then have you anything you could share on how February has been shaking out?
Yeah, I think, Brian, excuse me, we've seen really nice rebound. You know, we were seeing accelerating demand through the fourth quarter. It's just that it got hit particularly hard in the last few weeks as the storms came through, and we're very weighted towards North America, and that was a big hit for us. But demand was growing through the fourth quarter, and we saw kind of a step change into January. And so far through the beginning of the year, it's been pretty strong throughout. It's not just a January thing. And, you know, it's global. We've seen it in many places. We've seen it driven by lots of categories. International continues to grow. And remember, we're seeing a time where last year, this time, a lot of things weren't open yet. So things like cherry blossoms, international events, things like that are still growing. And people are getting back to that in a pretty robust way.
And where is China playing into this comeback?
Yeah, I mean, China's really not going to be, I don't think, in anybody's numbers in a strong way, meaningful way, until probably the latter half of the year. There's tons of demand. We're seeing lots of searches. We're seeing lots of searches in and out of China. We have B2B partners in China that are very important to us. But because of the flight lanes and how much airlift there is, it's still somewhat limited. There's a lot of rules, as you've probably heard about, in terms of getting in and out and testing for Chinese residents going into other countries. So there's a lot of demand, clearly. There's a lot of interest. But I think until the planes start going and we start really seeing that demand, a lot of demand's a little ways out. So it'll come through the numbers, I think, more in the back half of the year. But it's definitely growing. And Asia overall is growing as more and more opens up. And it's outgrowing kind of the rest of the world right now.
Hey, Peter, it's Julie here. What's sort of the biggest change that you've seen in the past 6 months? Whether it's where people are going, the length of time they are staying, et cetera. What kind of stands out to you?
Yeah, I think we're seeing some of the things we've talked about before, which is kind of normalization, which is to say, this time last year, it was Omicron. And so everybody loved Verbos and other vacation rental properties at other of our competitors. Now we're seeing a much more normalized mix towards resorts, hotels. Big cities are back in a big way. All the biggest, what used to be true, which is big cities sort of commanded the most search, is true again. So I think you're seeing kind of normalization back to big cities, normalization back to international travel. There's a little less, we're seeing a little less of these long stays where people were, never going back to the office and going to stay forever at vacation rentals. I think we're seeing a little normalization of that too. Still lots and lots of travel, but just a little bit more normal mix.
And I know you guys have been working on customer and user loyalty, right? Have you found that customers are pretty fickle, they'll jump around looking for the best deal? What are they prioritizing right now?
Yeah, I think, there's always going to be a class of traveler who maybe wants to save the last dollar and doesn't care who they book with and doesn't care what the service is. But we believe that travel is really precious time and that people generally care deeply about doing it right. And so we've been highly invested in improving the shopping experience in terms of knowing what you're getting, ranking all our suppliers in terms of the quality of their experience, giving customers more tools to shop and better understand what they're getting. Because we believe, most of us want to make sure we have the right trip, not just save the last dollar. And that goes all the way through to the shopping, the in-trip experience and the service side. And we found that our most loyal cohorts are the people we get into our loyalty program, people we get onto the app. And those have been our fastest growing cohorts during this last couple of years. So we're really excited about that. And we think the numbers, are proving that out. So, people do want to go trust their trip with somebody they trust, not just take a trip, in our opinion.
Peter, we've talked in the past about the turnaround that you continue to drive at Expedia. What inning are you in that turnaround, and what are some of your most just important goals for this year?
So I would say we're in the sixth inning, coming up maybe on the seventh inning stretch. Our big pushes this year are twofold. One, we're kind of finishing our big technical transformation. I mean, we're always improving our technology and adding features and capabilities, but we moved hotels.com onto the same front end as Expedia. We're moving Vrbo in the coming months, and then we're launching our big all-up loyalty program called One Key that's going to span all our biggest brands and be the most flexible, biggest rewards program in the industry. So that's a really big push for us that comes later this year. Once those two things are behind us, then it's sort of like the day-to-day, just improving and consolidating the back end. There's some efficiency opportunities there. So we're through a lot of it. And I said on our earnings, we're now at a point where we have more tailwinds from the things we've done than headwinds, but we still have a couple big things to do. But we believe we can drive really nice growth while doing those, as we have done in the past year.
Well, Peter, thanks for joining us this morning to chat about all of this. Expedia Group CEO Peter Kern, happy travels to you.
Nice to see you. Same to you.
Thanks.
All right, here we are in the final hour of trading. You're looking at gains across the board. This movement coming ahead of tomorrow's inflation data. For more on the recent action that we've seen, we want to bring in Jack Manley, JP Morgan Asset Management Global Strategist. Jack, it's good to see you. So we're looking at gains today as the markets have performed since the start of the year. It's been pretty strong. The NASDAQ leading the way, the S&P up just around 7.5%. From your perspective, the gains that we've seen so far, anything more than just a short covering rally?
I think that there's a lot of hope right now that the trend that we start to see emerge in inflation continues. And that's why, at least partially, maybe some folks home right now with the nurse and a hangover. But I do think, that given that we have that CPI data coming out tomorrow, it is just hope for yet another instance of evidence that inflation has turned over. And of course, the implication of that would be perhaps a change in Fed policy. And at the end of the day, rates have been the only thing that's mattered to markets for the last 13 months. So I see why it's happening. I see that the trend is very encouraging. I don't know if I necessarily believe in the legs of it short term, but long term, certainly we are closer to the end of this hiking cycle than the beginning. And that's something to be encouraging about.
And Jack, what if that number comes in hot tomorrow? What are the implications?
It depends why it comes in hot. That's going to be the big question. There are certain things that we can account for in the CPI print that may move higher and that we can just sort of brush aside. We know that energy prices may be moving higher in that print. That's not going to really move the needle too much, especially since headline figures are typically discounted. We know that shelter's been a little bit funky right now, and so reading too much into those numbers may be a little bit dangerous. The one that I do think we need to pay close attention to in terms of perhaps an upside surprise is what's going on with services, because that is where inflation has shifted. It's gone from supply over to demand, and if service inflation heats up a lot hotter than we would have thought, that's a little bit more durable. That's a little stickier.
What do you expect to see from services tomorrow?
I think we continue to see at least a flat, maybe a little bit of a moderation. The nice thing or not so nice thing about CPI is that the lion's share is driven by shelter, and so you can see modest upside or downside surprises and a lot of other factors that won't necessarily spill over into a big blowout, a high print or a significantly lower print. That's kind of the nice thing, I'd say. But the wage growth story, look, is a little bit frightening. It has held up a lot longer than we would have thought. Labor force structurally smaller than it had been in the past. That's going to feed through into services. It's going to take a while for inflation to get back down to something that we're more comfortable with.
What's a while, and what's something we're more comfortable with? Are we talking about 3.5% a year from now? And does the Fed just accept a different target?
So the funny thing about the Fed targeting, I think, is that we've been talking about a 2% Fed target on inflation for almost 20 years. And if the Fed was willing to persistently allow for an undershoot of that target, there's no reason to believe that they would not allow for us to persistently overshoot that target. I mean, very rarely have we actually come right in line with that 2% figure. So tolerating something above that without the Fed explicitly acknowledging a change to the target, I think is entirely possible. When it comes to the outlook for inflation, what should we be looking for? I do think 3-4% feels a whole lot more reasonable and certainly a lot better than where we are right now. How quick that happens, I do think has to do with shelter in particular. And we've been looking at some numbers on our end. If you look at what's going on with rent, which ultimately is what feeds through into services inflation, we start to see a very real moderating in those figures. And in fact, there are some major cities, New York City included, that have actually seen outright rent deflation over the last several months. It's going to take a little while for that to feed through, but halfway through this year, we may start to see some material downward pressure on inflation just based on shelter.
Yeah, and Jack, CPI is so important here to the markets because of the implications of what it means for Fed policy. We've really seen any time a Fed official speaks, the market really typically tends to move, and a lot of times hears what it wants to hear. Is the market putting too much, are they too invested with what the Fed officials are saying, and then instead, what should they be focused on?
Yeah, I got to control myself a little bit right now because I get a little heated when I talk about Fed policy. It's a real challenge, and I get it because, like we said earlier, rates are what matters right now for markets, and it's been the thing that matters for the last 13 months. So understanding Fed policy, look, that's critical. But when you hear some of the comments that are coming out of the Federal Reserve, like what we saw last week out of Powell, out of Waller, we have to acknowledge that all they're doing is stirring the pot. No new information gleaned from any of that commentary. We hear that, oh, well, maybe rates have to move higher from where they are right now. I could have told you that. The dot plot has looked like that since December. Oh, well, maybe rates are going to be higher and longer than what some people expect. Well, you know what? I bet we could poll a group of individuals and find at least one that thinks that rates are going to get cut by the end of this year, So, not a lot of clarity, no new information. What I'd rather pay attention to is the underlying macro data, like the employment report, which is actually a lot more complex than the number that we saw, like tomorrow's inflation print and what that may mean. That, I think, is going to help to steer a much clearer view on Fed policy. I would not hang off of every word out of every Fed governor. I think you'd go crazy.
Yeah. We are going crazy. We've already started going crazy.
He's the guy who says, I get heated when I talk about the Fed, said Jack Manley. Good to see you, sir. Thanks for being in the studio.
Thank you.
Well, ahead of that economic data and the earnings reports later this week, MasterCard releasing its January spending pulse report, and the consumer once again proving to be pretty resilient. U.S. retail sales last month, ex-autos, jumping 8.8% from a year ago. And it's important to note that those numbers do not account for inflation. For more on this, we want to bring in Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Michelle, it's great to see you again. So that headline number, 8.8% jump. Restaurant spending jumped about 24%. When you're taking into account the consumer right now looks pretty stable from our view, what are you seeing and what's driving that spending?
Well, you're absolutely right. I mean, it is an impressive increase in spending, particularly for some categories like restaurants, like you mentioned, or broadly experience-based spending. So there's some differences in terms of how consumers are spending, some choices that they're undertaking in terms of their basket of spend, but they are still out there spending. And the question is why and how? And a lot of that speaks to the health of the labor market. If you look at the last jobs report, over 500,000 jobs created. Wage growth is continuing, and aggregate wages are clearly still picking up, and that's supporting overall spend. So a lot of that is the consumer purchasing power that reflects the health of the labor market.
Do you expect anything in that story to change when we get retail sales on Wednesday? What do you think we'll learn?
Well, I think it's going to be, a strong report on Wednesday. We know that the last 2 months had, from the census data, contraction on a month-over-month basis. But we also know that the Census Bureau data around this time of year tends to be very volatile, very noisy, and subject to seasonal challenges. So I think once you smooth through the last few months, it should reveal an increasing trend consistent with what we're seeing in the spending pulse data. So it's important to look past some of the month-to-month swings. We may see a very big pop this month, but that would be after the decline we had the month before from the retail sales numbers from the government. So definitely look at the trend, and the trend is still showing the consumers out there spending.
Mm-hmm. Michelle, are there any signs of stress in the data that you're looking at, or any trends that you're seeing in terms of trade-offs? Maybe people are trading down, because that's something that we're starting to hear about in this quarter's earnings reports.
Well, I think the consumer is being mindful right now, and they're certainly making choices of how they spend, what they spend on, where they spend, et cetera. And it was clear in the holiday shopping season to us that consumers were being driven by the promotional period. We had a bit of a fits and starts to the holiday season, particularly for things like apparel or department stores, where you had a rush of spending around the Black Friday period and then another rush of spending right at the end of the holiday season. And that tells us consumers, are aware there's more inventory out there. They want to see discounting and promotions. And it's a bit more of a disinflationary psychology, which I think is also being reflected in the CPI data. And we'll see more of that when you look at some of the underlying goods inflation out tomorrow.
And that spending, combined with the strength of the labor market, what does it tell you about Jerome Powell's ability to bring inflation down near his target anytime soon?
Well, I think from the Fed's point of view, there are both demand side and supply side factors that are driving inflation. And the good news is on the supply side, they're getting a good amount of support. Supply chains have been fixed to some extent. We do have a lot more inventory in the economy, better inventory management. That's all really positive when it comes to helping to contain some of the inflation, particularly for goods. Now, the challenge, though, is that, when you think about the Fed's dual mandate, it's price stability, which goes hand in hand with full employment. And the unemployment rate is very, very low. It just hit a 53-year low in the last report. So they do want to take out some of that excess in the labor market, get to a more sustainable and healthy pace of job creation, which would still allow for consumers to be out there spending, but at a rate that, again, is more consistent with a stable and sound economy.
Michelle, despite all this, despite the fact that the consumer is so resilient, the labor market has remained pretty solid here up until this point, there are still calls for a looming recession, what that might look like in the second half of the year. Are you seeing that at all in your data?
I feel like there's been looming calls for recession for the most of last year. And, it clearly has not come. Now, I think we have to be mindful when we talk about what a recession is. Some parts of the economy are under a lot of pressure. The housing market throughout last year was in contraction territory when you look at home sales. And now when you look at home prices, you are seeing some sides of the manufacturing sector start to pull back. But when you put all the pieces together and you account for this real strength, particularly in the experience part of our economy, it's still an economy that is very much expanding and able to manage through what has been some tough headwinds, particularly when it comes to higher interest rates. But ultimately, the goal is to kind of rebalance the economy after the last few years where we've had quite unprecedented swings in economic growth and volatility. So we need to right-size the economy, and that, I think, is what we're seeing throughout the course of this year.
All right, got to leave it there. Michelle Meyer from MasterCard, thanks so much. Great stuff.
Good morning. I'm Julie Hyman with Brad Smith and Brian Sazzi. This is Yahoo Finance Live. Let's get right to the three things you need to know to start your morning. The first thing, a reality check for the U.S. consumer and the Federal Reserve. we're not done with high inflation yet. Consumer price increases sped up again in January, up 0.5% as measured by the Consumer Price Index, or CPI. What we call the core number that backs out energy and food rose 0.4%. And when economists talk about sticky inflation, that is where they see it. That is also the number that the Federal Reserve watches, and that could mean the Fed has to raise interest rates more to fight inflation. The second thing you need to know, Ford is shifting up a gear as it looks to secure its place in the EV market. It's cutting nearly 4,000 jobs in Europe over the next 3 years. The pain will be felt mainly by workers in Germany and the UK as Ford looks to save costs on its way to an all-electric fleet by 2035. The wheels are also in motion to build a $3.5 billion EV battery plant in Michigan. That's with the help of Chinese partners. The bigger picture, CEO Jim Farley wants Ford to be more efficient and quickly, especially after last week's rocky earnings report. And on to thing number 3, higher prices don't seem to bother Coca-Cola consumers too much. The drinks giant brought in higher revenue than Wall Street expected in the fourth quarter, demand holding steady despite the inflated price tag. Not all cheer, though. Things got a little flat in Coke's sparkling soft drinks, water, and sports divisions, and European volumes are still taking a hit as the region battles decades-high inflation. Momentum is expected to slow this year, with organic revenue growth seen between 7 to 8%. That's a big change from 16% in 2022. Let's get back now to what's top of mind for investors this morning, that January inflation print. Let's dive into it with John Hancock, Investment Management Co-Chief Investment Strategist, Emily Rowland. Emily, it is great to see you here. You know, I have to admit, I'm having a hard time trying to figure out what to make of this report, because on the one hand, I think investors have decided, they're prompted by the Fed, that these inflation numbers are going to start to slow this year. So how much should we consider this report?
Yeah, I think the market's having a similarly hard time trying to digest the report as well. We saw 2-year treasuries bouncing off the news, now looking flat. S&P 500 futures pointing to a higher open, but it's going to be a long day to figure out how the market digest the information. You know, I think it's important not to overemphasize one data point, but, you know, seeing CPI come in line with expectations, that shelter component is absolutely critical here. The rise in shelter inflation accounted for over half of the rise in total CPI. So we know that shelter, rents, housing, we know that's a sticky component of inflation. That's got to come down here over the next several months in order for the Fed to pivot as the market would like to see. So for now, we think that this gives the Fed fodder to continue to raise interest rates, probably another 225 basis points here in March and in May, and then they likely pause to see what happens next.
So how quickly, from your perspective, is the kind of environment for the U.S. consumer shifting?
Yeah, the U.S. consumer right now is on fairly solid footing. And of course, tomorrow we get another data point, likely another increase here in retail sales. So what we're seeing across the consumer is that right now their purchasing power is actually going up a little bit, considering the fact that inflationary pressures are coming down. So real purchasing power has increased and the employment market remains really strong. We're seeing the lowest unemployment rate, of course, in over 50 years. So the consumer is on fairly solid footing now, but we do expect that to change. Consumers are contending with more layoffs. We're starting to see that. It hasn't filtered through to the jobless data yet, but it likely will. We're seeing consumers dealing with an incredibly high cost of interest, credit card rates over 20%, auto loans at the highest rate in decades. And at some point, consumers are going to do the math here and decide that it's probably not worth it to engage in credit. So we do expect to see a slowdown there. But for now, the consumer is doing all right.
Emily, if you're going to get signs of disinflation, as you are seeing a little bit in this CPI report, does that tech trade deserve to come back here in the market?
Yeah, so we have seen a really tight relationship between interest rates and longer duration assets like technology. So I think if you did see a meaningful decline in rates here, tech would be one sector that benefits from that. But we look at technology as actually not being a terrible place to be, even in a choppy interest rate environment. A lot of these tech companies are very high quality. Quality is a factor we really like in this market. It means having a great balance sheet, lots of cash on their balance sheet, more durable profitability, a limited need to tap the capital markets in order to grow. So just like the consumer, businesses, we want to look for businesses that don't need to engage in debt at this part of the cycle. And tech is frankly the poster child for that. And I'm not talking about your, unprofitable growth at any price type tech companies. I'm talking about your classic S&P 500 tech sector. We also like value, but I wouldn't abandon tech and growth stocks at this point in the cycle.
Perhaps just for my own clarification, what would you define or kind of qualify as a meaningful decline in rates?
Yeah, so we look to the leading economic indicators to help us understand the likely direction of rates from here. And right now, the leading indicators are kind of screaming at us that a recession is likely to unfold potentially in the back half of 2023. We're at negative 6% year over year right now. And typically when the leading indicators decline, bond yields fall. Remember that investors tend to risk to lean into safer assets if they believe that economic growth prospects are decelerating. You're already starting to see a little bit of that coming down from the highs of over 4% on the 10-year Treasury back in October. So we do expect the entire yield curve to shift down as the bond market reprices for recession. You look over the last few cycles, the last few recessions, the 10-year Treasury yield fell on average 3% during each one of those periods. So we could actually see a similar decline here from the highs at the depth of the recession. It's going to take some time. Yields tend to be pretty choppy in these late cycle environments. They wouldn't go wildly overweight duration yet, but we do think that there's a big opportunity to embrace fixed income in 2023.
Emily, it's interesting to hear you so pessimistic here, because I feel like the sort of consensus tone has been shifting a little bit away from that scenario. Is it because maybe people aren't watching leading economic indicators as closely, or what do you think is folks are missing right now, maybe?
Yeah, and Julie, by the way, it's not very much fun to be pessimistic. I don't love talking this way, but we rely heavily on cycle analysis in our work, and everything is telling us that, it's not looking great. You've got the yield curve inverted to the tune of 80 plus basis points. Got the leading indicators telling us that recession is likely. You've got, the senior loan officer survey indicating that credit conditions are tightening. But at the same time, investors are cheering this idea that there's a light at the end of the tunnel as far as the Fed pausing. And there's always a kind of pivot party at the end of every cycle where investors recognize that inflationary pressures are falling. They look to the end of the tightening cycle as something to celebrate. The challenge is they typically underestimate the lagged impact of Fed tightening. And we think that that's exactly what's going on in this environment. Look, equity markets are telling you there's pretty much nothing wrong. We're seeing cyclical assets near all-time highs. We're seeing, a broad sort of risk-on environment here. We're seeing high-yield bond spreads kind of barely budging above 4%. The VIX has fallen. So calm has definitely taken over the markets, but we think it's a little bit early here to call the all clear.
On a positive note, Emily, it's Valentine's Day, so happy Valentine's Day to all. I, for one, am looking forward to having the chocolate I bought myself later. Very excited. John Hancock, Investment Management, Co-Chief Investment Strategist. Emily Rowland, always good to see you. We'll talk to you soon.
Thanks.
All right, Ford, the latest to announce major job cuts as the auto giant is set to lay off 3,800 people across Europe over the next 3 years. This comes as Ford continues to make a bigger push into electric vehicles as well as lower costs. Can't say I'm surprised by this news. Jim Farley stepped up about a week and a half ago on earnings, on that earnings call, and I think laid the gauntlet down to his team. Do better. And then while you're doing better, do it more efficiently. So I think this is the first in a series of just them looking to get more efficient. Ford, of course, late last year, released or let go, I believe, 3,000 workers or so. And let's keep in mind, this is a company that is now trying to split itself into two divisions. One division that focuses on traditional cars, another division that focuses on EVs. There's still likely a lot of waste in these systems. So Jim, I think just trying to drive a more focused business and get the love of the stock market back.
Yeah, on that call, they basically signaled that something might be coming. They said, given the changing macro environment, demand environment in Europe, they're going to make the changes necessary to deliver a sustainable business that consistently generates returns above the cost of capital capital. One of those costs of capital, of course, comes in the resources that you have across all of these divisions. And in Europe, the prioritization that Ford has right now is bringing a new factory online. That factory going to be in Turkey, actually. And then you also think about that 2 million run rate. It's going to be about bringing the factory online and getting the raw materials to that factory. And this directly impacting the number of people that they have running that operation in Europe as well.
I mean, I think wherever you look in the car market, there's enough to go around in terms of EV. But I think to your point, Saz, in terms of winning back the love of Wall Street, that is more going to be an uphill battle. If you look at Ford shares this year, they've bounced about 12%. GM's up about 25%. And Tesla, of course, Tesla does, weird things.
It's got its own short squeeze.
It's up to like 58%. Yeah. So we've really seen a switch here, it feels like, because it feels like GM and Ford have switched places in Wall Street's hearts over the past couple of years. And so if it's not going to be cost cutting that's going to get them back, I don't know what is. Cost cutting is getting them back in every other sector, right? In tech, you cut costs and people buy the shares. So if it's not going to be this, I don't know what the trigger is going to be for people to come back into the stock.
Yeah, it's also coming back to the number of different auto players, too, that are getting into Europe. There are going to be some heavy competitors in the form of Chinese auto manufacturers that are getting more into Europe. Many of them also coming into the U.S. And with that, there is a brand equity that they carry at the same time. And so for all of the electrification that's happening on some of the most equitable names that they have as part of their model lineups, for Ford, it's also about this box out effort that they're trying to initiate within that region while also trying to take on some type of market share, knowing that more competition is entering into the fray there, something that they also talked about.
Yeah, I'll just add to it. Importantly, at its core, at least Farley has Ford putting out vehicles that people want. The new electric F-150, darn good vehicle. The Mach-E, strong demand, darn good electric vehicle here. This is not like Ford's putting out, 1987 Ford Tempos and Escorts here. This is a company putting out higher quality products. It's just a matter of getting the cost structure right and then that flowing through to the company's profits.
All right, we're going to continue to watch shares of Ford going into the start of today's trading activity. We're also tracking shares of KO, Coca-Cola. Those shares are fizzling lower this morning, though the company continued to pass through higher prices, but Coke isn't expecting such a bubbly 2023, setting organic revenue growth expectations of only 7 to 8%. That's a deceleration from that 16% growth that they had seen in 2022. We're actually going to do a deeper dive into those fourth quarter earnings results from the beverage giant with Coca-Cola CFO and president John Murphy. That's later on in the show. You do not want to miss it. Well, switching gears here, even with inflation talk dominating both economists' group chats and Americans' dinner tables, consumer spending seems to be holding up surprisingly well. You can read all about the strong consumer growth in today's morning brief over at the Yahoo Finance homepage. But for a deeper dive into the numbers, let's get to the lady to my right. Julie Hyman.
Yeah, I wrote about this after spotting some of these spending numbers and ahead of CPI, which, as we saw this morning, rose 0.5%. Indeed is still accelerating, which is not the way you want to see it. But Americans are still spending, and that flagged in a number of reports that came out over the past week or so. First up, you have the Bank of America Institute that came out with its spending numbers, and those numbers look pretty good. They found that credit and debit card spending per household was up 5.1% year over year in January. That's an acceleration from only 2.2% in December. The reasons that they highlighted for this, I thought, were really interesting as well. First of all, they said some people were waiting for deals, waiting for more promotions to come.
It's me.
Right in January, to hit in January. So that was part of it. About half of U.S. states actually raised their minimum wages starting in January, so people were collecting more in their pockets. They were also collecting more from Social Security. Remember, Social Security did that big cost of living inflation adjustment, 8.7% higher, so people were getting bigger Social Security checks. And then finally, obviously, we had the big employment report for January, 517,000 jobs added. So all of that, says Bank of America, means that people had more spending power, something also that Emily Rowland was just talking about a moment ago. MasterCard Spending Pulse also showed strong numbers. And then there is also a report out from William Blair showing that people were spending more to go out, for example. So all of this equaling strong spending, but strong spending isn't all good. Right? That's sort of the issue here, because it's good news. It shows the economy's healthy. People have money to spend. On the flip side, what does it mean for the Fed? if there's all that demand out there, well, they might have to work a little harder to bring demand down and then bring prices down. So that's kind of the flip side.
So very true. All right, Julie also mentions in the Morning Brief newsletter the consumer urge to get out of the house, and that nearly 35% of people are spending the same on out-of-home entertainment as they were before the pandemic. For more on this, let's bring in Ryan Sunby, William Blair consumer research analyst. Ryan, you just did a survey on this. What are some of your findings?
Yeah, thanks for having me on, guys. As part of the consumer team here at William Blair, each month we go out and survey over 500 consumers to try to identify changes in behavior and attitudes. And so this month, our report that came out yesterday focused on travel and entertainment spending with an eye towards spring break. So I think circling back around to your discussion on CPI, while inflation is still, it's coming off its peak, it's still elevated here. And I think that does raise some questions around the spending on travel and entertainment, given its discretionary nature. But it does feel like this cycle is quite different. So I think what we're seeing here in our survey is that there's a strong demand to go back to entertainment, experiential spending that we saw before the pandemic started. And that's serving as this countervailing force to help spending hold up here. And that's something I think we're quite optimistic about that continue to go forward here. I know we're still early in the reporting calendar, but when you look at some of the early reports here, you saw strong ship-in data from Harley-Davidson. Royal Caribbean set 7 of their largest booking weeks in the past couple of months. And while Vail Resorts had some disruption around Christmas, their booking curves have returned to pre-pandemic levels. So I think we are seeing a strong return to experiential spending. And that is consistent with the data that we saw in our survey here. As you mentioned, more than half of the consumers that we surveyed are spending as much or more on experiential spending here. That's really consistent with when we asked that question back in July, which I think is encouraging as we've moved further from the start of the pandemic. So some of that pent-up demand has moved down and some of the stimulus is burned off. So I think we're pretty optimistic.
Yeah, I mean, the numbers are really interesting here, Ryan. How do you sort of tease out, when someone says, I'm spending more on going out, how do you sort of tease out how much of that is because they're going out more and how much of it is that when they do go out, they're spending more? I mean, I'm sure it's some combination, but is there a way to kind of figure out how much of each?
Yeah, it's a great question. So we do ask in our survey, how much are you spending more when you're at the venue or on premise there? And so we have seen a large pickup in terms of spending there. And looking forward, I think we came up with more than 70% of our respondents said they plan to spend even more when they're at a venue or on site. So that is a component. But we have seen, I think when you look at kind of the different income or the different age brackets of the return to experiential spending, we are seeing a lot of activity there, especially among younger consumers. So I think it's a mix, but I think, you're seeing kind of both sides of that hold up to drive demand.
There was a slight month-over-month move lower that we did see in some of the airline fares. You talk about that experiential economy and the travel part of that equation too. But year over year, I mean, we're still looking at prices that are nearly 25% higher versus January of 2022. So what is the new normal for the fares that people should be expecting when they do try to tap into that experience economy?
Yeah, it's a great question. And you're right. In our survey data, it is one of the few things that we saw move lower was demand to travel by airplane. I think a lot of that does kind of relate to, like you said, the higher airfare prices and some of the disruption we saw around the holidays. It seems like capacity is coming online slowly. We have seen airline prices move down since kind of May, June. I think they peaked last year. So I think that will help. And then, I think some of it has to be, more capacity comes online and that will help, ultimately, lower prices on that front.
And Ryan, you didn't necessarily lay it out in this report, but in your coverage, who's going to benefit the most from the trends that you're talking about?
Yeah, sure. I think we're big fans of experiential spending and the return to that. So I think there's a number of different ways you can play it. You've got someone like Live Nation that is connected all throughout the world in terms of the events they can put on and concerts and the memorable experiences they can create at a live music show. So we really like them. I think same thing with some of the cruise operators like Royal Caribbean or a smaller one like Lindblad that can capture this kind of pent up demand to go travel again. And then even on the theme park side, I think you could see some pickup there. We saw a nice improvement in our survey data there as well.
Okay, so I guess, Ryan, am I buying Renaissance tour tickets, or am I buying a ticket to Disney or Six Flags?
Yeah. Well, if you can get them, I'd buy the Renaissance ones. But no, yeah, I think our top idea is Live Nation. It's a name that we really like here.
All right, really appreciate the insights here today. William Blair, consumer research analyst, Ryan Subby. Thanks so much.
Yeah, thanks, guys.
Coming up, a shocking leadership change at Burger King owner Restaurant Brands. We'll discuss that. Plus, have the opening bell on Wall Street next. Restaurant Brands International announces a shakeup in its C-suite as the company announces earnings that slightly missed analyst estimates. The company's chief operating officer, Josh Kobza, was appointed as Restaurant Brands' new CEO effective March 1st, 2023. And this one surprised me a bit. Jose Sil, current CEO of Restaurant Brands, longtime friend of our show, started in 2019, has been reinventing the company here, has driven a successful turnaround, I would say, at Tim Hortons. Nobody's talking about it, but the numbers there continue to be strong in this most recent quarter. Started to reinvent Burger King as well, refocusing on operations there. But I do think this has all the fingerprints of new executive chairman at Restaurant Brands, Patrick Doyle, the, I would say, legendary former CEO of Domino's. He joined that board in late November. I think he wants to just continue to improve operations, maybe move a little quicker on some things. Now, Jose messaged me this morning here, a brief exchange. He said he's not stepping aside. He's just a little bit moving out of the way so the next generation of leadership could take that CEO mantle. But again, I would say Jose did a very good job, and I appreciate him always coming on with us.
Just to emphasize, this is a surprise,
yes,
right? I don't think any of us, and you follow especially this company pretty closely. Jose stepping aside is a surprise. He's only been in the CEO spot. He's been with the company for longer. He's only been in the CEO spot since January of 2019. And I was looking at the stock performance since then. The stock's up in the neighborhood of 33% or so, which is an underperformance. It's about half the gain in the S&P 500. It's also about half the gain in the S&P restaurant sub-index, which has a lot of his peers. So the stock has underperformed. And frankly, the earnings today were not fantastic either. Earnings per share missed estimates.
Yeah, and the stock is reflecting that this morning, down by about 3% pre-market. A few of the bright spots, though, and you guys know I love to talk about that Popeyes chicken sandwich because it's practically family at this point. But they had a really strong growth in terms of the number of different locations that they brought online for Popeyes. They're calling it the strongest development year since joining Restaurant Brands International, adding about 1,266 net new units with Popeyes there. And so that was their kind of restaurant overall growth that they were talking about in that acceleration. Digital sales, too. You were just telling me about your frequency with which you order chicken sandwiches, and the time of day will not disclose that you are getting those chicken sandwiches. Those digital sales, though, grew 30% year over year, $13.5 billion there in 2022. You can decide.
I will not mention that just yet, but I will just want to focus real quick on Josh's resume. He really checks all the boxes on what you would want to see from the next CEO of Restaurant Brands. Chief Financial Officer for 5 years, check done. At a time of ongoing inflation, you want to see that Chief Technology Officer. That Burger King app needs to get better, and he might be the one person to do it. Chief Operating Officer for 4 years, very, very important. And perhaps most importantly, he was integral to the acquisitions of Tim Hortons, Popeyes, and Firehouse Subs. It is largely assumed that this company will continue to buy up various brands over the next couple of years. They certainly have the balance sheet to do it.
Yeah, I mean, new slogan year for Burger King. It was you can have it your way for the longest time, probably since I was in grade school. Now it's you rule. So big reinvention year over at Burger King. We'll see if the digital side can continue to impress the one and only Brian Sozzi. Moving forward, we got to talk about Marriott International. They topped estimates in its latest quarter as the company notes leisure demand remained robust and group demand that demand more than fully recovered here. Just kind of diving into some of these numbers though, and as they're talking about where the demand is coming from, there is that mix of this leisure category basically that has basically been invented and started because of the virtual employee growth that we've seen over the past 18 months. And as some of those return to office plans get more communicated over the course of 2023, some of those already really kicking off, it'll be interesting to see where that leisure demand holds up in the number of people that are just able to still work from anywhere or have the kind of that increased hybrid capacity.
I just continue to be amazed by the results out of the lodging sector. Hilton last week, these Marriott numbers, system-wide constant dollar revenue per available room, key metric for them, up 28.8% in the most recent quarter. That's a huge number. Immediately I'm thinking Airbnb after the close might put up something pretty good as well. And this is all coming even as these companies push through much higher prices. Where are they getting the money from, Julie? Where's this money coming from? You wrote about spending today.
Well, it's coming from other stuff that people are not buying, right? They're not buying stuff. That's basically what we're seeing. We're seeing this big shift from people. Yes, they're still buying necessities, right? But people are not buying furniture.
Electronics,
maybe apparel in the same, and the apparel they are buying is cheaper, as we know, because of all the promotioning going on. So I think that's what's going on. I mean, listen. The company talking about that business travelers paid rates that were 3% higher than in 2019, and they're seeing more corporate negotiations higher for the coming year as well. So there's the business side. I mean, I don't know about you guys. I definitely have had sticker shock looking at hotel rates. So Airbnb, like for me, sometimes is comparable or better, particularly because I'm traveling with my family, right? So if you want more room, that's frequently going to be a better deal.
And there's a new type of customer that Airbnb could go after with regard to that. If you have a number of the corporate travel clients that are now looking at some of these hotel rates that are elevated, they're astronomical. Looking at some of the hotel rates in Austin, none of them fall within the company policy. So I don't even know if it's going to get approved. But at the end of the day, for Airbnb, they're saying, hey, why don't you just rent out a whole house? Just send everybody on your team to that one location. And I've seen some companies use that as an alternative as well.
Yeah, no, just
I hope you get approval, Brad.
Yeah, I hope so. go for it, Brad. No, but these are very strong numbers, and look, we heard the same thing the other day from Peter Kern over Expedia. He said year to date things have been strong. The way I read that is he gave some upside guidance to Yahoo Finance for the current quarter. They already told folks on their earnings call that January was off to a strong start. It looks like that momentum continuing into February. This whole space is hot.
It is hot. As we talk about prices and as we have the drumbeat here to the opening bell, got to talk about CPI again, right? We saw that 0.5% increase in CPI month over month, which is a reacceleration from the 0.1% increase in December. Core CPI, ex food and energy, up 0.4%, matching what we saw in December. So no slowdown in the increases in prices reported. And the year-over-year gain is 6.4% on a headline basis. There you have the opening bell on Wall Street. And the way that the street has been reading this, love that, black women on boards ringing the opening bell there at the New York Stock Exchange here in this Black History Month. And, the street is sort of trying to figure out what to make of these CPI numbers. Does it change what the Fed is going to be doing? Is it enough? The Fed has said pretty consistently that it watches the 3-month trend at least, if not the longer trend. So,
well, you have Jerome Powell, Fed chief, to thank for this. He's the one that got this whole train in motion regarding disinflation, and then his various folks on the Fed had to push back at this stuff. So I think he's just injected massive confusion into markets, Brad.
Yeah, well, taking a look at the confusion, at least out of the gate here on the day, let me populate this chart for us. Taking a look at the S&P 500, as of right now, we are lower by about 0.5% over the past 2 days, still holding on to some gains by about 0.6% here, but that drop at the open here reflected in this chart. You're also seeing the NASDAQ composite, that right now lower this morning, down by about 0.8% past 2 days, higher by 0.7%, and the Dow Jones Industrial Average, that is rounding out the downward trifecta, if you will. We are lower by about 0.5% for the Dow 30 components there, and still holding on to gains of about 0.7%, we'll call that, over the past 2 days here. Also want to take a look at some of the sector activity out of the gate this morning. We've got the 11 S&P 500 sectors loaded up on the screen for you right there. There's a lot of red there, so we're going to move quickly and expeditiously through this. But bringing up the caboose, we've got consumer discretionary, some of those elements of where consumers perhaps are pushing back on price or just saying we don't really need to buy. That really rounded out in that decline there, and of course that continued movement that we've been tracking over the course of, let's put this on a year-to-date chart perhaps even. There's been a little bit of a rebound in consumer discretionary, but then even as you think about the broader picture there, past year, 52 weeks, there is still a lot of ground to be recovered there. So we'll keep a close eye on that, especially in light of some retail sales data and then, of course, the consumer price index data that came out this morning.
Yeah, and one more thing to mention about the consumer price data and how things have been moving in the wake of that. Our Jared Buckley just highlighting some of the changes being priced into the market for what the Fed is going to do next. 1 week ago, about 36% probability that the Fed was going to finish raising rates in June. Now that probability is at 48%. So the likelihood that we could get a couple more increases from here is going up in the wake of this CPI report. But there's a long way to go from here to there. Let's talk about another mover. Shares of Palantir shooting up into the green after not only beating estimates in the latest quarter, but also achieving a significant milestone for the company, reporting its first quarter of positive GAAP net income. That is being profitable for the first time in the company's history, according to that metric. GAAP is generally accepted accounting principles. The welcome news doesn't stop there. Palantir also expecting to generate its first profitable year as well. The CEO, Alex Karp, saying a threshold has been crossed. This is the start of our next chapter. The company provides data analysis software to the U.S. government, to its allies. It's known as being somewhat secretive. The numbers are looking good. Saz, you highlighted a note this morning, though, from Citi that said the numbers don't look so good.
Yeah, well, they're, of course, Palantir. They can be secretive all they want. They still have to report their financial results. They're a public company. So interesting note by Citi here. The headline, the more we dig in, the weaker it looks, reiterating sell/high risk on this company. Really calling out, I would say, taking Palantir to task for a weaker than expected outlook. Also a significant decline in bookings and billings in the U.S. commercial segment. Citi is not liking this quarter. And I think it's a note like this. That is why Palantir is off some of these highs we saw ahead of the opening bell.
Yeah, this has always been an interesting company to track, whether it's been from a management perspective and Alex Karp's way of communicating very openly to employees who may not like the company's mission or how it deals with some governments as well as part of the different contracts that it tries to take on. With that government revenue growing in this most recent quarter, 23% year over year, hitting about $293 million. It's been extremely public. how he has tried to, I dare to say, lead the company, because there have been the reports of employees being extremely frustrated with the stances that they do take. He was a figure that was over in Davos, and it was interesting to see some of the comments that came out of that experience too. So we'll continue to see exactly what the navigation and the strategic leadership looks like.
Away from Citi, some of the other analysts are sort of mixed, calling out that profitability on a GAAP basis as the bright spot, but
by one-offs,
but flagging maybe billings going forward is not super strong. So
not a high quality quarter, I would say, from Palantir, but the market seems like it for now.
That's what analysts usually say when they want to throw a little shade.
That was my former gig.
It wasn't a high quality quarter.
No, it wasn't a high quality quarter.
Not the best, but still good, I guess. I don't know. Guys, coming up, who is Lael Brainerd? Rick Newman's going to break down everything that you need to know about President Biden's reported economic team shakeup. Next. President Biden is set to appoint Fed Vice Chair Lael Brainerd as the top economic brain at the White House. This is according to various media reports. Yahoo Finance's Rick Newman joins us now. Rick, tell us the significance of this.
Well, somebody has to run the NEC, the National Economic Council at the White House. Lael Brainerd is sort of a longstanding member of the Democratic Brain Trust on economic issues. She went to Harvard. She's an economist. She taught at MIT, so she's got Ivy League credentials. She's very smart. She's been vice chair at the Federal Reserve, and she has seemed a little bit more dovish than Jerome Powell on whether the Fed needs to, how aggressive the Fed needs to be in terms of interest rate hikes. I'm not sure how much that'll matter at the White House, so what her job at the White House will be. Biden's going to have a lot of regulatory stuff to deal with during the second 2 years of his term, including implementing all the stuff from the CHIPS Act, the Inflation Reduction Act, the green energy stuff that Congress passed during his first 2 years. So She will have a lot to do with that. And she's also very ambitious. She really wanted to be Fed chair when Jerome Powell got reappointed. She may be kind of positioning herself to be the next Treasury Secretary if Janet Yellen would step down before Biden's term is over. Or if Biden runs again and gets reelected, she'd be in a great position to be Treasury Secretary in the second Biden term.
And I've seen some interpretation that she is politically a little more progressive, that this is something that will please that side of the party.
Right, and I mean, how much is this going to matter at the White House? You know, this is an inside job. She's not really the face of policies. That's more the cabinet secretaries. But climate, for example, I think she is. I think she's pretty active in terms of a green energy agenda, and that is something that's going to be really important in the White House during the next 2 years. There is tons of green energy money coming into the economy, all that money from the Inflation Reduction Act. And it's really important how all of that gets structured, because Congress basically provides the funding, and then it's up to the administration to get it right. And you know, there's a lot that can go wrong when you're dumping money into the economy. So she's going to have a role making sure that money gets directed to the right places in the right ways.
And there's another story we're watching with a woman very much on the other side of the aisle. That is Nikki Haley, who has now officially announced her candidacy for president. So now on that side, we have her, we have Trump. I don't think DeSantis has formally announced candidacy yet, right?
No, he is not.
Does she have a chance here? What's the deal?
I think anybody has a chance at this point. It's pretty wide open because Trump is so wounded. So, you know, before 2020, Trump just blocked out the sun, and he made it very hard for anybody else to get in. But that has totally changed. Nikki Haley was the governor of South Carolina. She had a reputation as a principled conservative. You know, she was pretty mainstream on some things. She led the takedown of some of the Confederate statues in South Carolina, for example. She bashed Trump at the beginning. She really criticized him and said he's the wrong guy for the party. But then she flip-flopped and she became a Trumper, and she was Trump's ambassador to the United Nations. So and now she's not attacking Trump, but she's now coming out and saying we need to move on without naming his name. So I mean, really, I think she has some explaining to do about those flip-flops. She seems less principled than she did. She seems more of an opportunist because she just jumped into the Trump administration when it seemed like a way for her to get ahead. So she's got to deal with that.
Rick Newman, thanks so much. Appreciate it.
Thanks, guys.
All right, the average price of a used Tesla is now $20,000 lower than the peak reached last July. That marks a 22-month low, according to Chief Market Strategist at Creative Planning, Charlie Bello. Meantime, the vibe for new car pricing is entirely different. The average monthly payment for a new car soared to a record $777, nearly doubling from late 2019 per new data out of Kelley Blue Book. Coming up, we'll get a pulse check on consumer retail spending with an analyst from Roth MKM. That's next.
High costs are pushing value-oriented consumers to trade down and find better bargains. As Five Below, the retailer, is in a position to win the value shopper. The company's increased its store count. It's focusing on new on-trend merchandise. Roth MKM senior analyst David Bellinger says the company is well positioned to take advantage of this. He's labeling the company a buy in his latest research. David, thanks for being here. So, Five Below, you say in your note, has made a rapid shift to value-oriented merchandise. I mean, I always think of Five Below as a value-oriented player. What has changed?
Yeah, good morning. Thanks for having me on. So we upgraded Five as we believe this shift from the consumer standpoint to value-oriented merchandise has taken shape quicker than we originally anticipated. And I would say we have a broader spending backdrop that's a little more quiet at the moment. Inflation's still above 6%. The consumer's stressed to some degree, but they're still out there. They're still spending. And Five, they've got the low price points that are really working well in this kind of environment, whether that's in toys, tech, beauty, gaming. You've talked about Squishmallows on your show in the past and some of these other hot trends. So they've got momentum coming off a pretty strong holiday season. And I think that should continue to build throughout 2023.
Who do you believe, David, that this company is gaining market share from?
Yeah, it's coming from, I believe, all across the board, really, right? So you might have some trade down from your typical retailers, maybe like a Target and Walmart, right, where those toys could be a little higher priced, those value-oriented items a little higher priced than what Five is offering. But they are making that shift to scale up and have this Five Beyond concept, which I think is really interesting and still has a great value flavor to it. I've been in a lot of stores lately. They've got items priced upwards of $25. They've got that value flavor, like I mentioned, and I think that really has the potential to supercharge the revenue base for Five. I think it'll add a few percentage points of sales growth alone this year. And if you couple all that together with the freight, the fuel costs coming in, I think that makes for a nice earnings setup over the next several quarters. And we still see upside in the shares even at these levels.
It's interesting with some of the other companies that you cover as well. You're neutral right now on Lowe's and Home Depot, and that Beyond concept, it certainly kind of takes on more when you think about the number of categorical players that are also trying to implement that. I think of a Walmart and a Target that have very much of this Beyond concept that could infringe on a lot of these other very niche players historically, especially if there are low replenishment rates. So where does that continue to rattle some of the consumer discretionary shift in that spending over towards the players that already have their groceries and already have the things that they need to get on a day in, day out basis?
Yeah, it's a good point. What Five really stands out is they've got some of the best merchandising that I've seen in my career covering the consumer space, whether it's some of these hot anime trends that they're leaning into now. You've also got things like collectibles, Pokemon cards. They even had Kendall and Kylie Jenner exclusive products. So to me, that's a nice stepping stone for Five and just showing what kind of product they can get themselves, these exclusives in the store. And it's clearly a traffic driver. So you've got, teens and tweens coming in. Five's really one of the last few, if not the only kids retailer left in the United States broadly. And I think they're taking share, and it's become sort of this viral TikTok kind of business that they pick off these trends really early and they stock up. It's the perfect example of this was the fidget spinners a few years back, really put Five Below on the map, and they've really kept that core customer, and they've made Five Below the destination now, as opposed to having a customer come who's shopping at Target or a Starbucks or a Chipotle, and they'll stop off at Five Below and check it out. Now Five has become the destination. I think they're driving a lot more of their own traffic organically.
David, if this company stands to do well in a still high inflation environment where consumers are very value focused, what does that mean for two names that you also cover in a Home Depot and Lowe's that sell those bigger ticket items really at the same time as a housing market that is continuing to slow?
Yeah, so that's a concern I have. And I've been neutral on Home Depot and Lowe's from the start here. And if you look at some of these numbers they've put up, they've just been incredible. And for example, Home Depot, they've added well over $40 billion of incremental sales since 2019. And I think that's bound to slow, and that's somewhat healthy, right? To have somewhat of a give back here. And It's not anything bad about the company. It's more of the sector, I think, is slowing a bit. And if you've got home prices really starting to roll over and decelerate, in my mind, that's the biggest proponent of home improvement sales, is what home prices are doing. And if you do have some limited confidence on the part of the consumer to take on one of these big ticket projects, like a kitchen renovation that could cost $50,000, $80,000, if that steps back, I think that'll lead across other categories of what Home Depot and Lowe's sell. And you might have a bit of a softer 2023 here. And I think with the stocks trading at these levels, I think they're pretty fairly valued right here.
David, thanks a lot. Appreciate your time this morning. David Bellinger of Roth MKM. Thanks.
Thanks for having me.
Coming up, earnings season rolls on. Airbnb is set to report earnings after the close. What you need to know and what to listen for during the earnings call next.
Brian Zazia, Yahoo Finance here with Brad Smith, and we're getting ready for our latest After the Call. It is Airbnb.
It is indeed Airbnb, a great company that perhaps you've rented one or two homes from in the past.
Airbnb stock up 35% year to date, one of the hottest stocks in the entire market. And Brad, I know we're going to be on this conference call. Everybody's excited about the numbers, but I'm excited to hear who founder Brian Chesky has been renting his very expensive San Francisco house to. He's been doing this for months. I haven't rented it yet, Brad. I haven't rented it.
I know you're a fan of glamping. That's why you haven't rented it just yet. I'm going to be looking to see where that demand is holding up among consumers right now.
After the Call, Yahoo Finance homepage and YouTube coming up.
And indeed, stay tuned for After the Call with Saz and Brad today. They're going to break down all the top headlines from Airbnb's commentary. Guys, I want to know who got the Seth Rogen rental.
Oh, yeah.
Did you guys see that? He was renting out a night in his house where you could like throw pots with him and do whatever else Seth Rogen does
all
when
the Seth
he's at
Rogen
home. All the
things.
Seth
Yes.
Rogen things, presumably. So I don't know if they'll talk about that, but that was a fun little promo.
They've had some fun activations over the years, whether it's been renting like a Barbie dream house or even for Brian Chesky listing his own. And we were able to speak with Brian at the tail end of last year in Q4 during November when they were doing their winter release. It'll be interesting to see how many new hosts have also been brought online as a result of that winter release and the push push to trying to get more listings on the platform too, and what that does in impacting the average price that they're seeing per rental unit or per rental night.
Also curious to hear his tone around operating expenses for this year and how expenses really played out in that fourth quarter. This is a company that laid off a lot of people during the pandemic, and the going view on the street is they have not hired a ton of these people back. So they are probably one of the more lean tech companies, but do they even feel the pressure to let off workers here while a lot of their competitors are also letting off workers?
I'm always also curious to hear what Chesky has to say about where we are in the post-pandemic cycle of how people are staying, right? Things have changed so much. People were doing long-term rentals out in the country somewhere and working remotely, but a lot of them have had to come back to the office. City stays have gone up. Like, what is he seeing? Not just for what it means for Airbnb, but I just find it fascinating for what it says about the flow of people around the country and around the world.
Yeah, and even as some people are taking on those rentals, there are new rentals that have been coming online in jurisdictions that do not allow for Airbnb rentals, and thus some bookings have either been nullified or canceled, even as people are showing up to redeem their booking. And so that is something that, if he addresses it on the call, there's long been this kind of tenuous strain for Airbnb in all of the different regions that they try to move into, trying to get around local law in some cases, and then in others trying to drum up these different partnerships with even property companies to make sure that their tenants will have the opportunity to bring a unit online.
How are you going to do Valentine's Day, Brad? I'm trying to. It's going to be a late evening doing this earnings call. I don't know. I got to do a better job. But I mean, I'm not getting home until late. People better watch this thing. You better tune in and watch Airbnb. We have a lot of great analysis for you.
I know Brad has a Valentine.
But I mean, it doesn't matter.
Do you have a
Maybe I just want to go to the
Valentine's
bar and get myself a drink and wish I had one. Whatever it might be, I want people to watch this because we're bringing you some cutting edge analysis after the close. Me and Brad, we may not even have Valentine's Days. We're doing this all for you.
I'm getting tacos. I just told you that.
Getting tacos, yeah.
What bar are you? Where can the ladies out there find you, Sazi? What bar will you? Where will you be?
I'll take a photo for you. I'll take a photo. I'll send it to you.
But people need to know in advance so they
I don't
can
want them showing up.
Drop
Come
a
on.
pin.
No. It's kind of creepy.
All right.
Tune in after close.
All right, drop the pin so they can get that first impression, Rose.
Yeah, and we have some big conversations coming up in the next hour before we get to the after the bell and all of that. We've got an earnings breakdown with the CFO and president of Coca-Cola.
No Valentine's Day for John over there, Julie. Big day earnings day for Coca-Cola.
Yeah, I think he can probably squeeze it in later.
All right.
Stay tuned.
Welcome back to Yahoo Finance. I'm Brian Suzzi here with Julie Hyman and Brad Smith. Markets are locked in on today's CPI release and what it may mean for Fed policy. The early takeaway, there are signs of disinflation. Right now, we're seeing the markets, a little bit of mixed action. S&P 500 in the green, the Dow slightly in the red. Now, we have a jam-packed show for you this hour. Here's what's on tap. Dialing up the fizz, Coca-Cola CFO John Murphy joins us fresh off his earnings call. And crypto musings, Mr. Wonderful himself, Kevin O'Leary, is here on all things crypto and markets. Former SEC Chair Harvey Pitt will also weigh in on crypto. Roomba maker iRobot slashes staff just as it tries to close its acquisition by Amazon. We have the analysis you need to know. Brad, over to you.
All right, taking a look at the major averages here on the day. Dow Jones Industrial Average still in negative territory, but as you can see, off of some of the lows that we saw just after the start of trading here on the day. I'll give you some Valentine's Day candlesticks so you can see some of that upward movement that we've been seeing, that gap higher taking place just after the 9:40 a.m. Marker here, but we'll continue to track that to see if we can get into positive territory. Relatively flat, just barely to the downside there. The NASDAQ composite that has gotten into positive territory, that's up by about 0.5% right now. And the S&P 500, you're also seeing that in positive territory. That's in the green by about 0.2%. So catching some love for at least 2 out of the 3 major averages here. We'll see if the Dow Jones can find a partner there on the dance floor. The mega cap tech stocks, yeah, some interesting activity here on the morning. You've got Apple still down by about 0.5%. Microsoft there, that is positive by about 0.4%. Google also higher or lower as well by about 0.7% there. But Amazon also that is in positive territory by about 1%. And Tesla, keep a close eye on Tesla here on the day. That's up by about 4.3% here. So we'll watch that closely.
Yeah, some love for Tesla and Nvidia there in the middle of the screen. Well, year over year, U.S. inflation cooled slightly in January, down from 6.5% in December to 6.4%. However, last month inflation month over month rose by about 0.5%, accelerating from 0.1%. It was driven up by shelter costs. Here to break this all down is Tendai Kapfize. He is Wells Fargo Chief Corporate Economist, and it is a pleasure to welcome back in studio. It's been a while, Tendai. It's great to see you.
Yeah, good to be back.
So how should we be thinking about today's CPI report? We know that the Bureau of Labor Statistics changed the weighting within CPI, so shelter now makes up more of it.
Yeah.
But I mean, how concerned should we be?
I think the interesting thing with shelter having a higher weight is that, this month it contributed about half of the increase in the CPI. And we know from kind of private industry rent measures that shelter has been declining for about 5 or 6 months, right? Because of the BLS methodology, they kind of operate on a bit of a lag. So, you can be pretty certain that shelter is going to be decelerating throughout this year. So, that's a positive, I think, in terms of the outlook for inflation.
Are you on board with this notion that we will continue to see just steady disinflation in this economy?
Yeah, I think disinflation is the theme, right? I think the question is, what's the speed of that disinflation? How quickly can you get to a point where the Fed is comfortable that they have inflation under control? So that's kind of the outstanding question. But I think certainly disinflation is the theme, especially again with rents being half of this month's inflation. And we know from private data that rents are trending down.
And so with that in mind, for consumers who are trying to maximize their wages, even as disinflation is something that they might start to expect, then where might that spending start to shift into other categories, especially as discretionary spending has basically come off the table for a lot of households right now?
Yeah, I think the theme that we've been seeing over the past year will probably continue this year, right? Where there's like less spending on goods, more spending on services. Some of the good news in this report, right, was that airline inflation was down, right? So travel and vacation and those type of things. Maybe we're seeing some easing of price pressures in those areas. But yeah, it's all about services spending. People bought a lot of stuff during the pandemic. Maybe people don't need to buy stuff so much, and they're more focused on experiences.
Yeah, we've been seeing some data to that effect too. We talked to a William Blair analyst earlier in the show who talked about that a lot of people are spending as much, if not more, to go out as they did pre-pandemic. So if we're looking specifically at non-shelter services inflation, which we know the Fed has been paying attention to, what should we read into it as to what the Fed is going to do with interest rates?
Yeah, so I think the good news again in this report was that we saw a deceleration in non-shelter services inflation. It's still probably too high, right, for the Fed to be comfortable with. So once again, it's about the pace of the decline in inflation here. And I think that's what the Fed is going to be watching closely as they consider monetary policy going forward.
When do you see the Fed pivoting on policy?
By pivot, do you mean pausing or do you mean cutting?
Pausing.
Well, I think certainly, of course, in March they're going to have another hike. I think May is questionable, right? Right after we got that really hot jobs report in January, we saw that, the market kind of put May odds at like 73% for another hike in May. I would question that a bit. We get 3 more jobs reports between now and the May meeting. And we know that the January jobs number had a number of special factors, seasonal adjustment changes, benchmark revisions, et cetera, that I think that number was a little bit murky. And if you look before January, we had 5 straight months of decelerating job growth. So I think what you want to watch for in February, March, and April jobs is, do those confirm the January hot number, or do those confirm the decelerating trend that we saw before January? And then I think that's going to be the deciding factor for the May meeting. I think with CPI, if we start to see this rent kind of play out over the next couple of months, maybe we get some deceleration there. So I don't think May is a lock in terms of a hike. I think it's in question, and it's going to be data dependent, as the Fed often likes to keep telling us.
What do you believe is going to be the Fed's way of determining that after they kind of initiate that pause even, or at least the deceleration in the amount or the breadth of rate hikes that they have been doing in that policy, how will they look to some of those trends to say, okay, we're out of the woods, or we won't see another spike in inflation in the near future?
I think if you continue to see deceleration again, I think once you start to get a 2 handle on inflation, I think you get more comfortable, right? The Fed obviously won't come out and say that they're shifting away from the 2% target. But I think once you start to see a 2 handle, maybe you can be a little bit more comfortable. And then you kind of balance the mandate a little bit more in terms of not focusing so much on inflation. You keep an eye on the labor market. It's pretty hot right now. It's not going to be hot forever, right? At some point, the labor market is going to become a concern.
So let's come back around to a question about recession and soft landing, et cetera, right? Because the narrative keeps sort of shifting and the consensus keeps shifting. Where are you on that question right now?
Yeah, so, I think you can get a contraction, right, without a recession. We saw that early last year where we had 2 negative quarters of GDP, but the labor market was still really hot, right? So I think, there's been a lot of distortion in the economy from COVID and from, the monetary policy changes that happened during COVID and afterwards, that a lot of the correlations and relationships that we're used to watching in the economic data, some of those have changed, right? So I think what you can get is you can get pockets of weakness in the economy at different times that aren't necessarily coordinated or concurrent in the way that you'd see in a recession. So for example, the really interest rate sensitive sectors of the economy are already in recession, right? For example, housing, right? Which reacts very strongly and very quickly to interest rate hikes. But other sectors of the economy are going really pretty hot. So, it's a mixed bag. I don't know that you will get the traditional recession call in this cycle, but certainly we'll get kind of weaknesses in different parts of the economy at different times.
Great insight as always. Tendai Kapfidze, Wells Fargo Chief Corporate Economist. Good to see you. Thanks for coming in. Appreciate it.
Thanks, guys.
All right, ahead of Roku's earnings on February 15th, Evercore ISI is voicing its concern on the company's quarter and outlook, says the analyst team. Investor expectations for Q4 have also been lowered intra-quarter due to negative read-throughs from Google, Snap, Disney, and Comcast, and industry checks that suggest soft ad demand in Q4. Despite Roku's Q4 guidance seeming conservative and the company's strong intra-quarter accounts disclosure, we view the street's Q4 revenue and operating loss estimates as achievable with greater chance of downward versus upward estimate revisions. Coming up, the state of crypto regulation. Stay tuned for our conversation with former SEC Chair Harvey Pitt on the other side of the break.
The crypto crackdown continues. The U.S. Securities and Exchange Commission set to impose new rules for crypto firms, according to Bloomberg. The move would hamper the ability to handle client money and comes as regulators scrutinize crypto after the spectacular collapse of FTX, Three Arrows, and other mainstays. Joining us now is Harvey Pitt, Calorama Partner CEO and former SEC Chairman. Harvey, it's good to see you. You know, it's really interesting here because we've had Congress having hearings talking about crypto regulation. The SEC here is stepping in and doing it. Do you think that they're doing it in the proper fashion?
Well, I think the activity of the SEC raises some questions. It's sort of like the old Get Smart routine where the door says, knock before entering, and underneath it, the sign says, don't knock. What is required, I think, are rules of the road. That's critical. And they can't be done solely through enforcement actions. They have to be done through a comprehensive effort. That's the way to do it. And that's why these Senate hearings are so critical this morning.
We had a former FDIC official on with us yesterday and saying to Yahoo Finance with regard to why the U.S. and regulators here are hustling to take some type of action is because the rest of the world is looking to the U.S. as a leader in this. However, there's already some of the largest countries and entities that have decided to ban crypto. So how far behind are we in regulating crypto, and what needs to take place in order for us to finally kind of be ahead of any type of new innovation that comes within the space?
I think what's required is a comprehensive set of rules of the road. It's no use in telling people you have to follow the law if they don't know what the law is. Most people will try and follow the law, but they need to know what it is. And so doing this on a piecemeal basis, case by case with enforcement actions, doesn't really get us to where we need to be, which is a comprehensive regulatory scheme.
Harvey, what would be some of the aspects to that comprehensive plan?
Well, first, I think you have to designate someone to be in charge. At today's hearings, some folks are suggesting the SEC do the job, and that may make great sense. But whoever does it has to sit down and come up with rules of the road that explain everything from how you offer interests in these marketplaces, how you protect investors, how you verify assets and make sure that people are not being scammed. When they are scammed, obviously, you have to throw the book at them. But you need a book first, and that's what's missing right now.
Okay, and so do you believe that there is an understanding among the congressional lawmakers that are trying to figure out the boundaries to even put in place? Is there an understanding around the technology itself?
I think there is a growing understanding, and I think these hearings today are an excellent example of Congress acting in a bipartisan manner. This is really a hearing where there aren't any issues, Republican or Democrat. These are issues for the country and the protection of people who invest in cryptocurrencies. What's needed is a complete understanding of the benefits of these currencies and a way to prevent people from being scammed.
Under existing law, what remedies should investors in cryptocurrencies, those that have seen the collapse of other entities like a BlockFi or those that have been involved with algorithmic stablecoins or even FTX, what remedies should they be entitled to from your perspective?
Well, I think the FTX situation, as it's been set forth in the press, doesn't require new laws. It requires strong enforcement. There are real problems with the way all of that operated, and people were scammed terribly. And there's a lot of blame to go around, both on the private and the public sectors. I think there were a lot of folks who got caught unaware and who didn't take the steps necessary to prevent this kind of thing from coming. So actions against FTX and its founder are perfectly appropriate. Those are already covered by the law, but what we need are guidelines for how people should conduct business going forward so they can comply with investor protection and the rights of people who invest their money.
It would be good to get those regulations indeed. Harvey Pitt, Kalorama Partners CEO and former SEC chairman. Always appreciate you coming on. Thank you.
Thank you.
All right, for more on the crypto crackdown, be sure to stick around for a chat with Mr. Wonderful himself, Kevin O'Leary, at 10:40 a.m. Eastern Standard Time. Plus, on the other side of this short break, stay tuned for a sweet conversation with the CFO and president of Coca-Cola, John Murphy. You don't want to miss it. Coca-Cola shares on the move on the back of its earnings, with the beverage giant proving that higher prices hasn't deterred customers from its popular products. Coca-Cola president and CFO John Murphy joins us now. John, it's been a while. Welcome back to Yahoo Finance. Good quarter. Market seems to like these results out of you. And what really stood out to us, it looked like the first signs of disinflation in your commodity costs. What are you seeing on that front?
Morning, Brian. Nice to be back. We're seeing, in the first part of the year, we'll see a continuation of the elevation that we had carried through from last year. And we see some easement in the commodity front as we approach the middle end of the year. And so our thesis going into the year is that there will be some easing as we get into the second half of the year.
John, it's Julie here. What about your pricing? I'm curious. We've seen so many consumer products companies take price increases over the past year. Do you expect to continue to do so as we head through 2023?
Well, our starting point, Julie, is to earn the right to price. And so having a very strong marketing and consumer-facing agenda is our first priority. And from there, then, we adapt to market conditions all around the world. So we have taken pricing throughout 2022 on a very measured basis. We'll have some of that following into this year. And as we look to the back half of the year, that I would expect to moderate and to get back to more normal levels.
How are you changing the cost structure right now, even as you monitor where consumers are willing to take price and perhaps in categories where they're not buying as much?
Well, our cost structure, we took some actions coming out of COVID, and we have not been waiting around to right-size our business, to right-size our portfolio, and to make sure that we have a fit-for-purpose model going into 2023. So we feel good about our overall cost structure. I know working with our bottling partners, they have also been taking a lot of good actions to continue to deliver on both the top and the bottom line.
I know Coke really restructured how many products it was selling. That, I believe those efforts started early last year. I mean, I'm looking at the tea results, a little softish in the quarter, but are there other areas in your portfolio that you can fine tune, or you happy where the brands are in the portfolio?
You know, we're always discontent, Brian, and there are some categories where we've had some sluggish performance, I will say, but overall, the portfolio and the fine-tuning that we've done over the course of 2021 and 2022 is paying off. We are investing, I think, in the right areas, and we have, most importantly, we have our system focused on those brands that we believe have the greatest potential going forward.
We're just looking at a graphic here of your unit case volume across the different categories. Overall, unit case volume was down by 1%. When do you think you'll see reacceleration of that, and what do you think could trigger it?
So we actually had underlying volume growth in Q4. The headline number takes into account the impact of our suspension in Russia and also the impact of COVID in China in the fourth quarter. So Q4 was actually pretty much in line volume-wise with Q3, and we're seeing, as we go into 2023, we're seeing that momentum continuing year to date. So we're seeing some volume growth into the year. And over the course of the year, as we look from a global perspective, we expect to see baseline volume growth continue into the middle of the year.
And John, can you walk us through your plans this year for the alcohol category? I know you have a lot of things popping there. And is it safe to say that push into alcohol is no longer just an experiment?
It's you know, there's a lot of white space out there, Brian. We believe that we have a right to both compete and to play in that space, and we're exploring. We're exploring in a number of areas. We're learning. We're seeing some good traction with Topo Chico Hard Seltzer, for example. It's well embedded now in the business in the United States. We've got some exciting initiatives in the pipeline for this year. Jack and Coke will launch in the United States at the end of March. And so it's going to be a cumulative impact of a number of initiatives that I believe will give us the wherewithal to see this as a material source of long-term growth.
And within those initiatives, I mean, look, I love a good sugar rush as much as the next person, but when you think about where customer trends are pointing right now and taste profiles, where they're shifting, how does that prompt Coca-Cola to lean into certain categories, those that you were just mentioning even, versus some of the more historical parts of the brand?
Well, our best launch in the last, I'd say, 20 years has been Coke Zero. It continues to enjoy double-digit growth around the world, and it's just one example of a significant focus we have on promoting and selling low, no-calorie offerings in all of our categories. So it's a growth area, one we're intensely focused on, and we think there's tremendous runway ahead in that space.
John, we talked to the CFO of one of your largest competitors last week, and they told us they have reformulated their zero calorie or zero sugar formula drink. Do you have any plans to do something like that?
Well, we've had Coke Zero in the marketplace, as I say, for over 20 years, and we've learned as we go with the consumer. We've had a number of improvements. We love the formula we have in the marketplace today, and we look forward to another very, very strong year ahead.
Just looking across the sports category as well, sports drinks grew 1% for the quarter, 8% for the year. Where do you see even more opportunity within the sporting environment, knowing that for athletes, for the performance, performance files out there, I guess, that are looking for that response from their beverage that they're engaging with through sport or even after to recover? Where do you see new opportunities to either add on to the brand or just build more in-house?
Well, we like our portfolio of brands in the sports category in the United States with Body Armor and Powerade and overseas with Aquarius. And we see a lot of runway ahead. Body Armor is a new acquisition. It's coming off a challenging year for a number of reasons, but we're excited with the innovation pipeline. We're excited with some of the packaging we're bringing into the market. And then Powerade has been a fantastic core to the portfolio, and I think the two complementing each other in the United States will help us in the year to come. And as I say, overseas we've got a number of other brands, and the name of the game is to continue to follow the consumer, to understand where they're looking for edge, and then to be able to provide it with the innovations that we're bringing to play.
John, just lastly, I'm glad you mentioned packaging, because within this report you even talk about some of the packaging goals that the company has. I mean, we're talking about plastic bottles at the end of the day, and some glass in certain elements as well too. All of that considered, from your perspective, for Coca-Cola to get its sustainability efforts right, what would you need to see within the company, and what would you determine a win?
So, not having waste is a business imperative for all of us, and we are embedding that into our business agenda. It's not a separate agenda. It's all part of one overall agenda to drive growth, but to do it in a way that works for all. And so for me, it's to see our business leaders embracing and building it into their operating plans, and to demonstrate that we can grow the business and yet deliver on the objectives that we have publicly outlined.
All right. From this Cherry Coke fan, I just want to say thank you for joining us here this morning. Of course, all of us, thank you for taking the time here. Coca-Cola CFO and President John Murphy here on Yahoo Finance. Thanks so much. Coming up on the other side of this short break, the quest for healthcare domination there. What CVS's acquisition of Oak Street means for the space. That's next. Healthcare consolidation continues. CVS buying up clinic operator Oak Street Health for a cool $10.6 billion. The move turns CVS into something a bit bigger than just a drugstore chain with aspirations to match here. Here with more, we've got Yahoo Finance's own Anjali Khemlani. Anjali, what do we know?
Well, first of all, I'm issuing a mandate here that you guys are not allowed to call CVS a drug store chain anymore.
No mas.
Officially, no more. So let's take a look at what's happening. First of all, pull it out, zoom out, and look at what's going on in the healthcare space. We know that for years there has been consolidation and there have been what's known as vertical integration. So these larger companies, parent companies, buying up basically partners or entities that have nothing to do with their original concept. United Healthcare, for example, launched the Optum brand in 2011, and that does everything from owning physician care offices. They also have the Optum RX, which is their PBM play. CVS similarly owns Aetna now, right? That's an insurer. They picked that up. Humana also has a list, and Cigna as well, though their relationships are a little bit more multiplayer. They don't necessarily have exclusivity over a lot of that, but it still sort of begs the question, what's going on in the healthcare industry? Not a lot of people are paying attention to all these brands that are now under one roof. CVS stands out on that list. It's the only parent company that is not an insurer on the list you previously saw. So the track starts basically back in 2006 with that acquisition of the Minute Clinic. That's when they make their first play into healthcare services. They then acquire Caremark, which is their PBM play. Then they stop selling cigarettes, and we remember that push. And that really, changed the tide in terms of what CVS looked at itself as. It was more than just a pharmacy at that point in time. Fast forward 10 years later, we've got the acquisition of Aetna, Signify, and now Oak Street Health. So all of this really a major play in everything outside of that pharmacy space. And if you recall, quarter over quarter, we used to hear the front end is not bringing in money. The front end is not bringing in money. So here's what the company's really been doing when it comes to that. And how does Oak Street Health now play, in addition to Signify, which is another sort of provider service that they had, a home health service that they picked up last year for about $8 billion, so $18 billion in total here. We're looking at a little bit more. So Signify is one option for home health. Now this is primary care, but for older individuals. That's part of Oak Street Health. And we heard CFO Sean Gurdon on the earnings call recently saying, quote, that there's obviously things that they can do to kind of push, members to highlight that new Oak network. So all told, you're looking at a really different landscape when it comes to what's going on out there. We know a lot of people are, keeping an eye on Amazon, but I would say keep an eye on CVS as well.
So my question is, when I see these deals, whether it's CVS, whether it's Amazon, in theory, at least, I see them and I say, well, this should bring healthcare costs down, right? If I'm CVS and I own an insurer and I own all this other stuff, it's more in my interest to bring costs down, right, because I'm now paying and I now own the means to bring the costs down as well. But is that what's going to happen?
Well, that's TBD. And the reason why is because it's such a mixed bag of moves and players that any data that I tried to look for has shown either an increase in the cost or unknown because it's too much of a mixed bag. So we really do have to wait and see. The hope is once they get a handle over all of this, it will actually lower costs, or it can go the way of pharmacies. We saw pharmacies have been spinning off and becoming leaner, meaner machines. Pharmaceutical companies have becoming leaner machines. So it could even follow that route. It's just a wait and see.
Honestly, CVS really seems like the aggressor here, according to your reporting. What is Walgreens doing?
Walgreens also has a lot of moves that it's been making and is in partnership with Cigna, I believe, did have a pickup on the primary care front, but it's also a little bit different because it hasn't been moving as quickly as a major health provider in that sense, but it does have some moves. CVS and Walgreens are also competing to now enter the clinical trial space, which is something we've reported on before, so that's going to be interesting. Basically having locations where clinical trial patients can come into the location, so that's something that is a build out of the many locations that they already have, and utilizing that, as we saw during the pandemic, just how convenient those locations can be. So it's really just an interesting picture there.
One other footnote as we're having this discussion, I'm thinking back on CPI this morning, and I noticed health insurance prices have been falling for 4 straight months, month over month, down 3.6% in January. Medical care services overall, it looks like fell by 0.7%. So interesting trend that we are seeing there within the healthcare space. Yeah. We'll see how it ends up.
Anjali Kamani, thanks so much. Appreciate it. All right, coming up on the back of the fallout of FTX, we'll speak with one person who had a lot of skin in the game. Kevin O'Leary joins us next.
U.S. lawmakers on the Senate Banking Committee are meeting with academic experts today to discuss why financial system safeguards are needed for digital assets. Here to weigh in on regulation for crypto as well as risks and opportunities in the space is O'Leary Ventures Chairman Kevin O'Leary, commonly known in the streets as Mr. Wonderful. Great to have you here in studio with us.
Thank you.
First, when you think about some of the regulatory hearings that are going to be taking place in the foreseeable future now, until we get some borders for the crypto landscape to operate, what do you expect to not just come out of the discussions, but then timelines for actual movement on this front?
So let me give you the what's changed over the last few months on the Hill. You know, prior to the FTX collapse, and every week there was another crypto company blowing up and going to zero. But now they're getting really large in terms of how much capital is being gone. Just last week, Genesis filed again. This will continue over and over again, and so they'll keep going to zero because there's absolutely no guardrails in this industry. However, what's different now is, and I spoke to the senators at the FTX hearing after we'd finished them, and there was a chance to just get a feel of the tone of Washington. There's a fatigue coming into their thinking. They're tired of having hearings every 6 months when the next crypto company blows up and goes to zero.
Does that mean we just get rushed to resolution now?
I think that's what's going to happen. The heavy hand, and Gensler gave you that tonality last week on staking. He made it damn clear that he doesn't like it. And he, on the Kraken deal, he said, we just shut it down. Now, if you don't read the room, everybody, just look what I did. I shut down staking. Now, that takes the value of cryptocurrencies down a lot if they can't be staked. So this is the kind of environment we're in. The industry was unable to self-regulate itself. And, let's be honest. Every human heart has greed in it. And we are given the opportunity to issue worthless tokens with no guardrails. And, the BNB and the FTT tokens, those are worthless. And of course, these exchanges are going to go to zero because at some point somebody calls the cash transaction back to USD. So right now, take for example, BNB is 64 billion of market cap. The only reason to own that token on Binance is to get a discount on trading fees. What's the intrinsic value of that token? Nothing. It doesn't give you access to the equity of the company. Now, if you go look at the wallets, there's only 2 wallets that have 97% of all of those tokens. I wonder who owns those. What happens if one of them says, I want cash? Does Binance have 34 billion USD of cash? I don't think so. So my whole point is these things will keep blowing up over and over and over again. And finally, the senators are saying on these committees, we're done. Let's put the heavy hand of regulation down. And that's probably a good thing long term.
Kevin, last time we talked to you, you were very fired up. You had a skin in the game with FTX here. Where are you at in the process of getting any of your funds back?
The narrative now is now taken away from the focus on the alleged fraud, because that's just going to go through the courts and take 7 or 8 years, who knows, towards recovery. So since we last talked, we know of a $4.2 billion pool that supposedly the Bahamians have, supposedly. We know of a $1.2 billion pool of assets, maybe cash, that FTX US has, supposedly. We know of $400 million of cash somewhere. You add that up, there's a lot of shareholders and account holders saying, okay, everybody, let's talk about where this money is. And what everybody wants right now, and putting the real pressure on John Ray, is to say, look, turn on the exchange again, gate it so no assets can leave it, so that each account holder can see what they have or had and see the transaction records, which we still don't have yet. And supposedly, again, rumored is it's all backed up on AWS at Amazon and can be turned on in a moment's notice, alleged, so to speak. So we don't know. But the litigation is piling on. There's 1,000 lawyers who are going to make a lifetime living off this thing. It'll go on for a decade or more, and let the pieces fall where they may.
Do you have any money anywhere left in crypto?
Oh, sure. I reestablished positions, and what I did is I moved it all up to a regulated exchange up in Canada, because there are no I'm never putting my money into an exchange that is at war with its regulator or being litigated by its regulator or doesn't have any regulation. So the only order I know of in North America that's working is the OSC, which is allowing broker-dealers and exchanges to operate under a legislated order. Now, it's very restrictive. There's only 34 tokens allowed. There's very limited staking. But it's audited by the auditors and the government every month. There's no commingling. So I moved all my assets up to BitBuy. It's actually a company that's trading publicly called WonderFi. I own a huge piece of it, but it's safe. So I've reestablished 6 positions now, and frankly, it's one of my best performing assets since January 1st.
Well, FTX was performing well until it wasn't, and FTT was performing well until it wasn't. Like, what's your takeaway after what happened with FTX? What was your lesson learned? What are you going to avoid doing? I mean, yes, it was a fraud, and they were taking pains to not reveal what was going on, but what can you
What gives you any confidence to put your assets in any exchange anywhere that isn't regulated? Because
well, what gives you confidence? Even if it is regulated.
No, that's different. That's like saying, are you willing to trade on the New York Stock Exchange? Yes, I am. There are rules. NASDAQ? Yes, I am. There are rules. The regulator sees every transaction. It's a mark-to-market in every case. These exchanges are no different than those. There are rules already established that exist for the New York Stock Exchange. Why not apply them to a crypto exchange?
An asset on the New York Stock Exchange can still go to zero.
Of course, but that's diversification on individual names. But the whole exchange doesn't go to zero. That's my whole point. And so I'd like to see these rules. Now let's talk about what's on the Hill, because you brought that up. Senator Loomis, and is now moving that bill forward again. Toomey was the senator that was pushing for regulation on digital payment systems. Now it looks like Haggerty's going to pick up the baton, if you want to call it that, because Toomey is retired January 3rd. But the point is, you're seeing these hearings, you're going to see more of them, and every week we're going to be talking again together about the next thing that went to zero, because there's plenty of zeros coming to a theater near you until we actually force regulation on this. Because who wouldn't make a worthless token? I mean, think about it. What do you need a token for that's supposedly ownership in the exchange? You're not allowed to do that in a bank. You're not allowed to do that in the New York Stock Exchange. If you want to buy a piece of the New York Stock Exchange, buy the equity of the exchange. The same thing should be for any exchange anywhere. That's the deal.
As part of that regulation and as part of the hearings, we're going to hear about the endorsements that took place with companies like FTX and exchanges. You'd previously revealed that you had a $15 million payment as part of the FTX endorsement.
$18 million.
$18 million payment as part of that. Do you believe that as part of the proceedings that crypto promotions or endorsements should also be banned?
I don't think that's going to happen. People advertise regional banks. People advertise money center banks. I think you're allowed to market your services, but obviously all of the people involved, from Tom Brady on down, had no idea of the alleged fraud that was going on. They wouldn't endorse that, and that's intuitive. That makes sense. So there's going to be a lot of frivolous lawsuits with contingency lawyers. I get that, absolutely going to happen, and that's probably a way of cleaning it out. But it's not going to change the way financial services are marketed. That you see that on television every day. But I think what it does do is change the regulatory environment. And remember, there's one attribute to an exchange that is very, very valuable, and why the golden ticket would be to be regulated by the SEC or whatever the U.S. exchange regulator is going to be. In order for you to transfer your fiat currency in any jurisdiction, let's say you're in Belgium or in London in the British pound or in Zurich in the Swiss franc, you have to be regulated to be able to do that, so that you can take it out of an account in Swiss francs and transfer it to a broker-dealer exchange that's crypto. The Swiss aren't stupid. They're going to regulate that. The Canadians have already done it. At some point, there'll be a passport system around the world that if you want to trade globally on all these different geographies and get access to their banking system, you're going to be regulated. Everybody's waiting for the U.S. to set that up, and that's why these hearings are very important.
Kevin, you're also really plugged into all things tech, and since we last spoke, we've seen a real meteoric rise in all things AI stocks. Do you think this is a bubble? Have you used ChatGPT, and what do you think of this technology?
Great question, because as we speak, even this morning, I'm trying to make up my mind on the allocation to this next round on OpenAI. Very fortunate to be offered to take down some equity, but it's a $29 billion valuation with virtually no revenue. So I'm choking on it. I'm looking at it, and yet within our own shop in the last 90 days, we are using a third of our search time on ChatGPT instead of using Google, because it's scraping the internet for us. And we do a lot of research on deals, on people, on companies, on goods and services. And so now the team, on their own, is just, now that they know how to use ChatGPT, and for the very first time, I noticed an expense report last week where somebody put on the $20 a month. And so I said, well, what's with this? She said, look, boss, the thing is always down. There's 100 million people a day taking it down. It's jammed up. At least when I pay the 20, I can get online and do the work for us. So I said, well, they're getting revenue. All of a sudden, because they're so popular, they assumed they were going to get 1 million downloads a day. They're getting 100 million a day. Now tell me that's not killing Google, and it is. Google's got an advertising-driven model. You don't advertise on ChatGPT. You don't need to. You don't need to buy your search results. So, it's going to be a really interesting changeover. But my take is we'll probably add a 1% weighting into ChatGPT in the portfolio that should hold that. Although I'm holding my nose on valuation. I'm choking. This is so not Mr. Wonderful valuation. Like, I should be getting a royalty deal on this thing.
Well, I imagine you'd be a little bit more upset if they started expensing some of their Twitter Blue verification marks as well. Just while we have you, because of the ventures that you've invested in, all of the different companies, a lot of the economists that we've spoken with are putting in their base case a mild recession right now.
Yeah.
Of the companies that you've invested in, is there a percentage that you don't believe would make it through a mild recession? No,
I have to tell you that what's going on in companies with 5 to 500 employees right now, that's 62% of the economy. We're really struggling in terms of what we should do for building inventory for the next 2 quarters. We just don't know what's going to happen. And so we need to be in stock to have sales. But everybody keeps telling us, including the Fed, we're going into a mild recession, but we don't see it yet in our numbers. So the real dilemma is how much capital do we tie up in inventory? And so the reason I bring up that number is I want to do a quick segue into something I discovered since I last talked to you guys that I'm all over now. No one knows this, but during the PPP plan, do you remember the PPP? Well, we took that down to the Bank of America, lots and lots of it. And we were told that there was something called the Employee Retention Credit, which we can't apply for if we took the PPP. I didn't know in the middle of 2001 they changed the law because it was so bad, the recession that was potentially going to occur during the pandemic. They said, let's open up the Employee Retention Credit. It's 170 pages, that program, very complicated, but it pays up to $26,000 per employee that was on a W-1 or W-2 in 2000 and 2001. I'm urging every company in America to go figure this out for themselves because that money has already been thrown out of the helicopter waiting for you to pick it up. And so for all of my companies we're applying, and I've set up the wondertrust.com for anybody that wants to learn more about it, just go there. You have to hire an expert to do it. You need an accountant, but is it worth it? Oh my goodness. I mean, if you have 70 employees, your check could be $1.1 million, and you could put it right back into the business. Not debt, no interest charges, no costs, you don't give up equity. The government wants you to have this money, go get it. This is my #1 mandate for the next 25 months.
We're going to see which of the small businesses and businesses out there heed the call as well. O'Leary Ventures Chairman Kevin O'Leary joining us here in studio at Yahoo Finance. Thanks so much, Kevin.
Thank you.
Coming up, everyone, job cuts are expanding. We're going to discuss the latest company that's just been hit with layoffs. That's next. Layoffs are expanding to the iRobot, with the Roomba maker announcing it's going to be cutting 7% of its employees, equal to about 85 of 1,254 workers. This comes amid the company's acquisition process by Amazon. iRobot and Zumba, of course, the Zumba that you might have moving around your apartment or your home somewhere.
Yeah, well, I think this is, of course, a reflection, I would imagine, of consumers spending more on experiences than on stuff like we've been talking about too. Prices for these vacuums have gone higher as well. And oh yeah, the housing market has slowed down. Put all that together, I'm not shocked to see these layoffs here. But again, this deal is still not closed. Not closed yet for Amazon. I think there's a lot of focus on them getting more access to our data.
And you were just looking at a study from Jefferies that talked about people being worried that their jobs are going to be automated. Although I don't know how many people are worried about Roomba taking their maybe they are, I don't know.
Yeah, Jefferies noting in this particular survey, 82% of those polled will go out and get new skills if they fear that AI is going to take their job, which is pretty interesting.
Makes sense, I
It does.
guess.
Yep.
All right, that does it for us today. Coming up, Rochelle Akufa is going to continue our crypto regulation conversation with the Chief Strategy Officer at CoinShares. Don't miss that.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufa. So let's get you caught up with what you've missed so far in the first 90 minutes of the trading day. How inflation stays sticky, complicating the road ahead for investors and the Fed. We'll deep dive into the impact on your day-to-day, everything from eggs to Bitcoin. And authorities ramp up scrutiny of the crypto space, with the SEC making big moves in recent days. Is this the beginning of a wider crackdown? We asked the head of strategy at CoinShares. And oil prices slip as the Biden administration dips into the strategic reserve once again. Now, will it help lower prices at the pump, or is it just another political football? That's just ahead. First, though, a quick check on how the markets are faring at the moment. We saw after that CPI data came in, all three into negative territory there. The Dow there off more than 212 points there, about 2/3% there. The S&P 500, they're also down, but slightly less though, down about 15 points on the day. And the tech-heavy NASDAQ there, still at least faring the best of the three major indices there, but down about 21 points still. Let's also check in on the Treasury market, as a lot of people looking for some safe havens here over potential fears of recession. We see especially the 5-year there up more than 2% on the day, the 10-year up about 1.33%, and the 30-year there up about 0.5%. That one turning positive, having been negative earlier this morning. Right, so let's take a look at that quick look at markets out of that recent CPI data. Joining us now, Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, and taking a look at that data, the Consumer Price Index, and what it showed for the month of January, it was up 0.5% from the previous month, year over year, up 6.4%. Now, the components that led to this rise, shelter, that came in sticky. That was the biggest contributor. And I do want to note also that January CPI incorporated new weights. That means that the shelter component is a little bit larger in the overall index. Other categories that rose as well, vehicle insurance, apparel rose, home furnishing rose as well. One of the categories that actually fell, though, is used autos. Taking a look also at the core inflation, that's excluding food and energy, that was up 5.6% over the last 12 months. And the energy index, that one was up 8.7% for the 12 months ending in January. Also want to note that the food index rose 10.1%. So what does this mean for the overall markets? Well, we saw the reaction this morning. You saw stocks that actually had risen for a bit. And when we take a look at risk assets like cryptocurrencies, I do want to show on our Wi-Fi interactive board, I have that pulled up. You're looking at Bitcoin that is up right now more than 2%. Here is the move that we saw when the report came out. I'm just going to pull up the little chart where I can actually draw on this. We saw that big move here when that report came out. It's not uncommon than when we see CPI prints, when we see big reports that come out, when we hear Jerome Powell speaking, that you will see Bitcoin have this outsized move. So during these big inflation reports, it's not surprising to see an outsized uptick. And you can see Bitcoin, it had been up as much as 3%, now up more than 2%, Rochelle.
As we can see there, as you mentioned there, crypto not following what the equity markets are doing at the moment. Great stuff there, Ines Ferre, there for us. Right, well, CPI data not the only concern in the world of crypto. The Securities and Exchange Commission imposing new rules, but may not be moving fast enough. Here's what former SEC Chairman Harvey Pitt had to say about creating guidelines in crypto.
It's no use in telling people you have to follow the law if they don't know what the law is. Most people will try and follow the law, but they need to know what it is.
Well, joining us now to discuss regulators' next moves is Meltem Demirors, Head of Strategy at CoinShares. This segment brought to you by Intuit TurboTax. Good to have you on the show, Meltem. Obviously, a lot of confusion here. It can be a little bit hard to know exactly when you've sort of stepped outside the bounds of the SEC, as we've seen here, especially after that announcement that we heard about Kraken. We saw that SEC Chair Gary Gensler saying, look, this should put everyone on notice in the marketplace. How are some of these crypto companies heeding this, though?
Look, crypto has long been regulated. Anyone who's providing financial products or services and offering them to U.S. customers or operating in the United States is subject to the rules and laws of the United States. And as the video from Mr. Pitt showed, there are a lot of companies in this space who have been trying for years. Kraken has been actively operating for over a decade now to follow all of the different rules, whether it's securities laws, whether it's tax laws, whether it's OFAC and compliance laws when it comes to sources of funds. So the biggest challenge we have here is we have a regulator who is attempting to regulate by enforcement. And at the same time that this regulation by enforcement is happening, there's also been a massive de-risking across the space. Banks are evaluating the risk of being a counterparty to crypto companies. We have auditors saying we want to de-risk our business because, again, there's just all of this additional scrutiny. And after the last year, we saw Celsius, Voyager, FTX, and a number of other platforms have material failures, material breaches of fiduciary responsibility. So I understand the desire to do something, but regulation by enforcement is not really a path forward that is really workable for U.S. companies who are attempting to comply with the rules, but they don't know what the rules are. So it's a little bit of a catch-22, to be candid.
It certainly does seem that way. We saw that Kraken CEO tweeted, oh man, all I had to do was fill out a form on a website and tell people that staking rewards come from staking. Wish I'd seen this video before paying that $30 million fine and agreeing to permanently shut down the service in the US. How dumb I look. Oh gosh. So it's really a case of, as you mentioned there, sort of this enforcement strategy. But then what can companies and some of these crypto exchanges do then if there isn't a way to really get ahead of what the SEC and other regulators are doing? Is it a case of lawyering up and just sort of bracing for what happens next?
Honestly, I think that is the path forward. We have a number of cases that are likely going to go to the Supreme Court pertaining to crypto. One of them, if you'll recall, is the situation this summer with Tornado Cash, which is a open public protocol that people can utilize to obfuscate certain data around transactions. That case is now going, to get much more attention. There are 2 lawsuits underway there. I do think one of the challenges here is crypto doesn't fit neatly into the box of existing financial services. And at the end of the day, it's impossible at this point, I think, to put crypto back in the box or to shut it down. The only thing that can be done is sort of to try to delay or temper its growth and its integration into the broader financial system by shutting down some of these on and off ramps, or at least restricting flow. And so I think there are going to be landmark cases. There are going to be companies that are going to pursue this path of action. But at the end of the day, it's a very costly route. It's very time consuming. And unfortunately, in the current market environment, there aren't so many companies, especially younger, early stage companies that may not have as much capital or as much financial resources, much social capital and political capital. So I think it is a challenge, but there needs to be case law. There needs to be precedent. And again, the United States, right, this case law is very important to setting precedents that can be utilized in the future. So I do expect there will be a lot of lawsuits that will happen, and a lot of these things will have to go to a level where these discussions can be had. It's disappointing to me as someone who's been working in this industry in the United States for the last 8 years, because there are a lot of companies who've been operating for the better part of a decade, who have a strong track record, who have appropriate governance, who provide transparency. And unfortunately, it's been very challenging when crypto is a regulatory political hot potato that gets passed around. But it may be that this is what's needed to provide that clarity and to establish the case law that will set a precedent going forward.
So then, as we speak about things like clarity, but also credibility, when you look at some of the leading voices that the SEC relied on, of course, you have to talk about FTX's Sam Bankman-Fried. Then who now are the leading voices that regulators could or should be listening to as they do try and shape the industry for the better?
That's a great question. I think one of the interesting challenges here is the transparency component when it comes to looking at on-chain versus off-chain activity. The issue with everything that happened in the crypto credit crisis over the summer is a lot of that was led by off-chain activity where there is no transparency. You can't rely on this public ledger, this public data source for verifying. And so one of the things that we think is really important is obviously having more publicly listed companies. In the US, we have Coinbase and a handful of others in Canada. CoinShares is a publicly listed digital asset investment firm, but we're listed in Europe. But I think the transparency of having audited financials that are published on a quarterly basis, along with guidance and commentary, is really important to helping analysts, investment banks, as well as regulators and investors understand some of the nuances of how companies earn money in this business. There are also companies that do a lot of voluntary reporting. And I think the last component is there's a lot of nuance here when it comes to crypto. Even when we use a word like staking and we're trying to understand staking rewards, every protocol has a slightly different mechanism. The risk implications of staking your assets are slightly different. So that nuance is really challenging in an environment where, I've been in this industry for almost a decade and I have trouble keeping up with all of the latest terms and the terminology is confusing. So there are, I think, multiple components. On the education side, there are a few great firms in the US, whether those are think tanks or trade associations that are trying to educate in Washington, D.C. But I think it is challenging because this is entirely new and it doesn't fit cleanly into how new markets have historically been regulated. So a lot of fundamental challenges. We're working hard to make progress to overcome those, but it's very expensive, very time consuming. And at the end of the day, it's very difficult when people are not willing to come to the table and engage with the industry.
Very true. You certainly need that clarity in order to be able to move forward. I do thank you for joining me this morning. Meltem Demirors, the head of strategy at CoinShares. Thank you so much. This segment brought to you by Intuit TurboTax. Right, order up. Fast food specialist Restaurant Brands International is promoting COO Joshua Kobza to the top job of CEO in March. Now, Kobza, who takes over from Jose Sil, comes as RBI aims to grow its roster of brands, including Popeyes, Burger King, and Firehouse Subs. Its Popeye unit, famous for being a key player in the chicken sandwich wars, continues to see sales growth during the fourth quarter, marking its strongest development year since joining RBI, according to The Call. Right, well, coming up, staying with food, we're talking eggflation as the avian flu outbreak continues to drive prices. Stay tuned as we crack down on that story. So inflation is still elevated, but if you read between the lines, there's a lot more going on than just the headline number. Certainly lots to digest on the eggflation front. Let's get to Yahoo Finance's Brooke DePalma for the latest. Hey, Brooke.
Good morning, Rochelle. Ag still in focus for both consumers and Main Street as the prices continue to rise higher in the year's first CPI report. As you can see right there, year over year prices up 70.1%. That's compared to December's nearly 60% jump that caused consumers to flock to social media, I guess you could say, causing dozens of memes, that is. But overall, month over month, it's up 8.5%. That's lower than last month's 11.1% jump. Now, the average price of eggs still remain high for a dozen large grade A eggs. The price is about $4.82 in the month of January. Now, of course, the leading cause of these higher prices continues to be the avian flu outbreak. In 2022 overall, we saw 43.3 million birds impacted by that outbreak. Now, one agricultural economist did say that in January, there was the egg-laying flock was 1% lower than in December due to a recent, once again, outbreak that impacted and caused further loss of egg-laying hens in the month of December. But there is some hope here. Wholesale prices are decreasing, or rather dropping rapidly, and therefore consumers could see prices go lower in grocery stores. But with Easter just around the corner, don't bet your bets too high on this one because increased demand typically does mean higher prices on the shelves.
So still some high prices to hold on to, at least for the moment. Not any relief anytime soon yet. But Brooke, what other things stood out to you in this consumer inflation report?
Yeah, well, of course, this was a read across all categories for food as well as energy and gas. But in particular, I am taking a closer look at both lettuce and citrus fruits. Lettuce last month getting the attention of Grammy Award-winning rapper Cardi B. Of course, she typically takes a closer look at inflation. But this month, it's down 3.6%. Last month, we saw bad weather as well as a crop-destroying virus that spread across California to drive prices higher. Citrus fruits there still up 2.8% month over month. This comes as Florida saw a decline in citrus production due to the fact of another disease that was caused by an insect known as citrus greening, it's called, Rochelle, as well as a frozen freeze last January and damage from Hurricane Ian, that is. Now, that crop of 18 million boxes in Florida was the lowest since the 1930s. Now, of course, less citrus being produced causes an impact on companies like PepsiCo, who has orange juice in their portfolios. But in recent years, we've seen more of these companies go to foreign markets like Brazil. But for consumers, this, in fact, does mean that this month they will still see citrus prices higher on the shelf.
Yeah, I was keeping an eye on those orange juice prices that were rising. I think they've tapered off a little bit, but they have been very high, especially this year. Brooke DePalma, thanks so much. Well, investors digesting the latest consumer inflation print as the strong report is likely to keep the Fed on track to hike interest rates and signals a likelihood of further increases as recession remains top of mind. We'll hear from more on the inflation expectations and what investors could do amid a more hawkish Fed. We have Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Good to have you here on the show. So, first, I want to talk about this market repricing. Has it finally sunk in that the Fed is more hawkish than they expected?
To some degree, but not fully. The terminal rate in terms of the peak rate that the Fed will get to at some point in the first half of this year is now at roughly 5.2%. So markets are appreciating roughly two more rate increases, one in March and another one at their May meeting. But markets are still anticipating roughly one rate cut still in the back half of the year. And again, the Fed continues to profess that they're going to stay higher for longer. This suggests that they'll keep rates above 5% for the duration of 2023. And they're getting signs that they've been right on this call. You think about the strong BLS employment report in January. You think about the recent CPI print this morning, which still suggests that, yes, the disinflation process has begun, but the Fed probably feels like they have a lot more work to do. So I think, the Fed is doing a little bit of hand-holding, getting the markets closer in line to what they're calling for, but we're not fully there yet.
So when we look at the month-to-month versus the year-over-year for the core CPI data, what is that signaling then about how much longer the Fed will go and for how much longer? Or could even a pause be on the table at this point when we do have this inflation print?
Well, of course, the wild card continues to be sticky shelter inflation. Now, we can argue at length in terms of the BLS's calculation of shelter inflation and how it lags real-time lease rates as well as home price appreciation or depreciation. But it does suggest that shelter might continue to stick around at least for the next couple of months before it begins to decelerate. Also, I think we did see a rise in the Manheim used vehicle index, and some proponents were expecting we were going to see a tick up in used vehicle prices. We actually saw that come down, so that might have been a welcome number from the CPI print. But all in all, I still think that this is going to be a bouncy ride for inflation on the way down. Now, the Fed continues to talk about core services PCE inflation ex housing. Now, that figure has been trending down somewhat, but again, it's still sticking around a bit higher than what the Fed would like. Right now, year on year, it's running at about 3.8%. That longer run average is about 2.5%. So all these signs suggest that the Fed, again, still has a little bit more work to do. And I'm not sure markets still appreciate just how much higher and longer the Fed is willing to keep rates.
And it's interesting because when you look at how disinflation is affecting goods versus services, and we know that Powell was especially honing in on the services aspect here. I mean, do we get the sense that we can avoid a recession if we don't get that aspect under control?
So I really struggle with this idea of this immaculate disinflation, right? i.e. inflation coming back down to the Fed's 2%, us being able to avoid recession, and then the Fed turning around and being accommodative sometime later on this year. It's very unlikely for all those three things to happen. I think you need to have some pain in the labor market in order to get that inflation rate back down into the Fed's, ballpark. And so we're not seeing that the economy's coming under some pressure, some braking power being applied to the economy, but it does suggest that we can continue to hang in there. But if aggregate demand remains strong, that would suggest that inflation can continue to run a bit hotter than what the Fed would like. And that positions the Fed to, again, tighten a little bit more aggressive, break something in the economy, and dip us into a recession sometime in now, I guess we're pushing it back maybe a quarter or two, the end of 2023, earlier parts of 2024. So I think the market, this rally so far this year is maybe a little bit premature. We're not out of the woods yet for higher rates for longer, and that's going to bite further on down the road.
So then what's the investment strategy here when you do have markets moving in one direction while the Fed's still trying to beat the drum that they're going to be more hawkish, potentially an extra 25 basis point hike ahead somewhere?
Yeah, I think you still position a somewhat defensive. I think there could still be some pain amongst tech stocks. Again, if we're talking about higher rates for longer, that's going to be a bit of a headwind to longer duration equities like growthier parts of the market, like sectors like technology. Also, we can't ignore the earnings backdrop. Some of the forward guidance that we've gotten hasn't been very constructive, particularly amongst big tech. And so I do think there could be a little bit of weakness there. If you think about the bond side of the equation, for the first time since the early 1980s, you now have paper 1 year and under or maturing in less than a year that's yielding more than intermediate core bonds, than the Bloomberg aggregate. And so if you're looking for income, just a comfortable place to park your cash, cash is a decent alternative at this stage. But if you are looking for protection, insurance, if you buy into the idea that the Fed is going to keep hiking rates, want slower growth in order to bring inflation down, you've got to own a bit of protection. You've got to own a little bit of duration at this stage. And with the U.S. 10-year now touching 375, I do think this is an attractive level for investors to begin engaging a little bit of duration in high-quality core bonds.
Certainly everyone has to do their homework and decide on their risk tolerance and, of course, their time frame as well. A big thank you there to Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Thanks so much. All right, coming up, oil prices having a down day as the Biden administration says it will dip into the Strategic Petroleum Reserve once again. We discuss the impact on oil and gas next. The inflation battle isn't over yet. That much is clear from today's CPI report for January. But outside the headline number and key components like housing and energy, the cost of services is still largely elevated. Pricey air travel is a big issue for Americans, and our chart of the day gives us a sense of the rise over the last 3 years. But the good news, after increasing 4 times the rate of inflation in 2022, the cost might be coming down. Airline fares joined used cars and trucks, showing a decrease on the month in the latest CPI report. Meanwhile, oil prices having a down day as the Biden administration says it will dip into the Strategic Petroleum Reserve once again. So is there likely to be any impact on prices at the pump in the next few months? Let's get to Yahoo Finance's Rick Newman to find out. Hey, Rick.
Hey, this is different from what we saw last year. So the Energy Department is releasing about 26 million barrels of oil from the Strategic Reserve because the law says it has to do that. This dates to a 2015 law Congress passed that said the Energy Department has to periodically release some oil, sell it into the market, and then take that proceeds and use it to upgrade and maintain the reserve itself. So this is not something Biden wants to do as he did last year to provide relief in the oil and gasoline markets. This is something they have to do because the law says they have to do it. 26 million barrels, not a huge amount. I mean, we've seen oil prices come down about $1 or so per barrel in the last 24 hours. That may be related to this announcement. That's well within the range of a normal market gyration. So this will have a little bit of effect, I guess. But many analysts think we're going to see oil prices and gasoline prices drifting upward into the summer. There's still pretty tight supply around the world, and China is reopening. And China is a huge energy consumer that's going to create a lot of demand for energy.
Well, speaking of drifting upward, what's the latest surrounding, of course, these floating objects taken down by the U.S. and its impact on, of course, its relationship with China?
Information is eking out. The Senate is set to get a briefing from some Pentagon officials. I'm sure that a lot of that information will leak. I saw a news report saying that the Pentagon has recovered basically what they think are all of the significant sensors that were on that first balloon, the one that we see there on the screen that got shot down off the coast of South Carolina. So the Pentagon's saying they got basically all the major sensors off that balloon from the debris that landed in the ocean. That means they're going to be able to figure out with a pretty good accuracy what exactly that balloon was doing. Was it taking pictures? Was it doing audio surveillance, technical surveillance? It's possible it was all of the above. Let's remember that was a large balloon with a payload or a suite of sensors that was supposedly the size of a small jet attached to it. So that's a lot of capability on that balloon. And I think we're going to be getting some very interesting updates on what the heck that balloon was doing.
And Rick, we seem to be getting some sort of tit for tat from China, also saying that they had some unidentified flying objects from the US over their airspace. What does it mean when you get in a tit for tat with the two biggest economies who clearly are so interconnected that they do need each other economically?
No, people should not freak out about this. This is not, the beginning of some kind of war between the United States and China. I mean, intelligence, one up, one down. This sort of stuff goes on all the time behind the scenes. What is different about the balloons is that the public is getting a glimpse of the spy game that goes on between these nations. So that does create political pressure in both nations to do something about it. So here in the United States, you're seeing Republicans criticizing President Biden, saying he didn't act aggressively enough. I don't agree with that. I think it's good news that balloon, the first one, stayed up as long as it did and gave the Pentagon a lot of opportunity to monitor it and see what it was doing. But in China, there's obviously political pressure to respond to this criticism from the United States, and that's why we saw the Chinese government saying, "Oh, the United States has done this too. We're not the only ones." They're almost trying to make it out as if it's normal behavior to send spy balloons over other countries in the world. It is not normal behavior. Every country in the world has the right to sovereignty in its airspace, and this should not be happening. But the big question, of course, is has China been periodically or routinely sneaking these objects into U.S. airspace unnoticed? I don't think we know that yet, and we still don't know those 3 other objects that the Pentagon has shot down. What were they? We still don't really have any word. Were they spy balloons? They were apparently a lot smaller. One of them may not even have been a balloon at all. So it's quite intriguing and kind of fun to follow. We're going to get a lot more information.
We'll certainly be keeping an eye on that. I'm sure a lot of people are wondering how much information will be released about all that debris. Rick Newman, thank you for getting us up to speed. All right, coming up, love might be in the air, but is it hurting your wallets? We discuss the heartbreaking prices surrounding following the special day. Stay tuned. Prices rose at the fastest pace in decades in 2022 and continue to climb into 2023. But it's not stopping people from spending money this Valentine's Day. Yahoo Finance's Alexandra Semenova has the details. So some big spending then going on this year?
Exactly, Rochelle. Love is in the air today, but it is going to cost you. U.S. consumers are expected to shell out just under $26 billion this Valentine's Day. That's according to an annual report from the National Retail Federation and data firm Prosper Insights and Analytics. That number is one of the highest on record and up $2 billion from last year. As you said, it appears that inflation is not stopping people from shelling out big bucks on their loved ones. At the individual level, more than half of consumers celebrating are set to spend an average of about $200 per person, a jump from roughly $175 per person in 2022. Now, I do want to point out this report doesn't necessarily factor in inflation, so while prices are certainly higher across the board on most items, the spending plans could be a combination of both higher costs, but also a general rise in the amount of money that people are willing to spend. It's a testament to the resilience of consumers we've seen, even in the face of inflation and economic uncertainty. Now, today's CPI report does show that prices are up meaningfully overall from last year, as well as on popular Valentine's Day gifts and ways to celebrate. Dining out out, for example, is up 8.2% over the year based on the food away from home component of the release. Food at home for those who want to enjoy a romantic night in with their significant other is up 11.3%. The prices of popular gift items are also up. Jewelry and watches were 4.9% more expensive in January than they were in 2022. The cost of flowers up 5% over the same period. Now, going back to the Valentine's Day survey, looking at the most popular gifts, candy, greeting cards, flowers, and an evening out were most popular. One notable finding from the study was men were more likely to give the gift of experience this year compared to last year. 32% of consumers plan to gift an experience, up from 26% last year. And we've been seeing that trend hold up post-pandemic, with consumers shifting from goods and services spending on experiences like travel, dining out, and events instead. Rochelle?
I love that. I have been seeing that trend towards more services, like, spa days and things like that. $200 though, I don't know. Maybe I'm a cheapskate. I'm not spending $200.
Me as well.
Thank you so much. Alexandra Semenova, thank you so much. Well, love is in the air, but secrets are hidden all around. 39% of US adults who are married, in a civil partnership, or living with a partner have kept a financial secret from their current partner. That's according to Bankrate. And interestingly, younger generations are more likely to report being financially unfaithful, with a majority of Gen Zers and millennials saying they've kept secrets about money from their partners. Well, joining us now is Black Wealth financial advisor Jamila McClooney. She's created a game to help couples start these discussions about money in a fun, low-key, no-pressure way. Good to have you on the show, Jamila. I love this idea of doing this as a game, because talking about money, talking about your own finances, let alone having to share that with somebody else, that's tough. So talk about why you decided to create this game and what you're really hoping to achieve here.
Oh, I created this. Well, I've been a financial advisor for about 12 years now. And I remember going to see couples, and I went to see a married couple, and the wife said, "Look, my husband doesn't know how much money I make, so don't mention it to him when he comes." And I was thinking, wow, and I work with couples, and it's usually one of the couples wants to talk about it and work together. The other party in the couple just doesn't want to discuss the money. So there's a lot of secrets going on. And I realized that people aren't having the conversations about money that they should have. So knowing that communication, infidelity, and money issues are the top reasons for divorce, I said, I have to do something about it. Let me make a conversational game that's fun, that people can have the conversations that they should be having.
And are you surprised that when it comes to a very vital relationship, your relationship with your finances, that people are still really tight-lipped about it, even in terms of asking themselves some of these questions? Because some of these very insightful things like, have you done anything embarrassing for money? I don't know how many people are going to admit to that, but these are the sort of things that, one day when you apply for a job or something, that might come up. Why do you think we have such a hard time, I guess from a behavioral economist perspective, in really understanding our relationship with money?
I think there's shame associated with it. And we're in an era where everything is shown, being better than what it is, Instagram, TikTok. So people want to present well. And there's just a lot of shame and uncertainty around how they'll be perceived if they're honest about what's going on in their finances.
So I'm going to start with some of the cards here. I'll start with one that's not too painful. So here's one that says, how do you feel about the gifts I buy you? I don't know how likely you are to get into an argument about that. And the other one there is, what are you afraid to tell me about your finances or financial situation? I mean, these are some tough ones. First of all, talk about the gifts one. What does that question help people understand about their finances and how they relate to each other?
I think sometimes people overspend. Maybe we just looked at the stats for how much people are spending this Valentine's Day. Maybe you don't have $200 to spend, but you're charging or borrowing or doing something so that you can impress the other person. So, or maybe your gifts are too cheap and I don't like them. So we need to talk about that so I can get what I want.
I love that one. Another one, what's a financial deal breaker in our relationship? How aware are people of these financial deal breakers, and what sort of tend to be the kind of answers that come up?
I think excessive debt is a big one. I don't think people are really aware of it as how it would affect them until they actually think about it. And it's important to think about that because, when you get married, your debt, joins. So how much debt do you have? how's your credit score? What have you been doing with your money? Do you have any money? Do you have any savings? So those things are important.
And when you think about things that people ask, another one is, how would you describe my relationship with money? So this is how the other person views your spending. And that could be tough because, I've been guilty of, hiding a few bags in the back of the car or, pulling something out slowly and putting it in the closet later on saying, oh, no, I've had that for ages. But it's really a trust issue as well. So what does that mean in terms of how we're conditioned to think about our financial relationships? And because it even affects how we spend, how we invest as well.
Yeah, I think we don't know how the other person's going to feel or if we're going to be judged for the things that we spend. Usually there's big differences between what your partner might think is important to spend money on and what you might think is important to spend money on. So keeping it secret is just an easier way to go. Or like you said, hiding those bags in the back of the closet and bringing them out at an appropriate time is just a little easier than maybe having those conversations up front.
Well, clearly the discussions do need to be had. This is great stuff. And this is whether you're single, dating, in a committed relationship. Definitely some questions we should all be asking ourselves. Thank you for joining me this morning. Financial advisor Jamila McClooney. Thank you so much. All right, coming up, Starbucks is in some hot water after terminating pro-union employees. We'll discuss next. Starbucks is in hot water after the National Labor Relations Board found that the coffee giant was guilty of illegally threatening and terminating pro-union employees. Yahoo Finance's Danny Romero has the latest. Hey, Danny.
Yes, Rochelle. So Starbucks is facing the pressure once again, but this time is a little bit different. A group of Starbucks workers at a Philadelphia store started their own unionized efforts, but they were cut short. They are allegedly accusing of Starbucks of threatening, interrogating, and also terminating pro-union workers. As of Monday, the 3 Democratic members from the National Labor Relations Board ordered Starbucks to cease and desist. And they also offered reinstatement with back pay, for terminating those 2 employees. And now we reached out to Starbucks in regards to their side of the story, and they tell us we disagree with the decision and are considering all options to obtain a full legal review of that matter. Now, the company continues to say that any claims in regards to anti-union activity are categorically false. The ruling of the NLRB can be appealed in federal court. But I also want to give a little bit of background. Allegedly, those 2 workers recorded video without consent, which is against Pennsylvania state law. So that's a little bit of the background. But so far, according to Starbucks Workers United, there are more than 270 stores that have successfully filed unionization, and there are more than 315 stores that are filing for union elections. Michelle?
I mean, when you look at the rate of success for some of these that are trying to unionize, I know you're getting pressure from the unions, you're getting pressure from the states as well. How do you think this is going to work out for Starbucks when you look at some of the momentum that we're seeing?
Well, obviously, we saw a huge wave, right, just in 2021. But again, like I said, this case is a little bit different because those unionized efforts started way beforehand in 2019. But again, Starbucks has made their claim that, they are not against they are actually for their partners, and obviously things are rolling out, and this isn't the first claim against Starbucks that we have seen, that the National Labor Relations Board has voted and been on the side of the partners. So I think it's a wait and see, but obviously this movement is progressing. I mean, if there's more than 315 stores that have filed for unionization, I mean, we're really seeing this activity pick up.
Indeed, Danny Romero, thank you so much for that update on Starbucks there. All right, well, the U.S. auto sector saw prices tick slightly higher overall month over month in January, with new car prices steadily climbing every month since March of 2021. Yahoo Finance's Prasa Romanian joins us now to discuss. I mean, people might be looking for a car. You don't know if you should go better used or new at this point, depending on what you're seeing with the prices now.
Yeah, Rochelle, you mentioned that new car prices up 12 months since March 2021. This is after the BLS revised some of this data. So, for the most recent month here in January, new car prices up 6% year over year. New car prices up 6% year over year, and used car prices down over 11%. Excuse me. Like I said, this trend's been going on for some time now, and leading to new car monthly payments to hit $780. Wow, that is a huge amount. And the reasons why are pretty typical here. We've seen low inventory due to part shortages for new cars. Automakers actually now prefer to have low inventory because they want to do this sort of model where they actually don't push cars to the lots, but actually pull them to the lots. We want demand to come there first before they actually send cars out there. We want to focus on luxury, higher margin offerings, and also focus on things like software, which is a very high margin thing where you can add different features like adaptive cruise control, things like that as an add-on feature. So will things change? Yes and no. For the used car market, we might actually see a little uptick there because spring buying season is upon us. Things like tax refunds tend to affect people's behaviors towards maybe buying a used car now. And for the new cars, a lot of the automakers expect the inventory to improve and prices to come down a bit with incentives as things get better. But if inflation stays stubborn and rates remain high, you might see more and more people who want to buy new cars go to the used car lot.
Or maybe even EVs, depending on the tax credit, which of course brings us to Tesla. Tesla changing its prices for the 4th time in 2 months. What's happening here?
Yeah, so, ever since they had that massive price cut back in January, around almost 20% for some of their cars like the Model Y, Tesla's been tweaking their prices for the Model 3, Model Y here and there, up a bit, down a bit, up a bit, down a bit. Not much of a material change, just a few percentages here and there, because they're just seeing that they can kind of tweak their demand, tweak their supply, tweak their sort of pricing model in real time, because they're allowed to do that. They have a fully online model. They have a website that shows their up-to-date pricing. They can do this and experiment, see what they want to do with that. Whereas most automakers set their prices a couple times a year. They can't actually take advantage of different dynamics in the market. So for Tesla, you'll see them do this here and there, and you'll probably see a correction here end of March when we have new battery requirements and possibly the tax credit kind of either goes away or gets cut in half. So we'll see. So this is just going to be a norm until at least the summer.
Be interesting trying to time it out and figure out when's the best time to buy one there, but we'll be keeping track of that. Price Romanian, thanks so much. All right, coming up, Airbnb set to report earnings after the bell today. We discuss what you should be keeping an eye on. Stay tuned.
Brian Sazia, Yahoo Finance here with Brad Smith, and we're getting ready for our latest After the Call. It is Airbnb.
It is indeed Airbnb, a great company that perhaps you've rented one or two homes from in the past.
Airbnb stock up 35% year to date, one of the hottest stocks in the entire market. And Brad, I know we're going to be on this conference call. Everybody's excited about the numbers, but I'm excited to hear who founder Brian Chesky has been renting his very expensive San Francisco house to. He's been doing this for months. I haven't rented it yet, Brad. I haven't rented it.
I know you're a fan of glamping. That's why you haven't rented it just yet. I'm going to be looking to see where that demand is holding up among consumers right now.
After the Call, Yahoo Finance homepage and YouTube coming up.
So just so you know, that will not be Brian Sozzi's house that you were seeing there on Airbnb. But of course, Airbnb is set to report earnings after the bell today. So stay tuned for After the Call as Brian Sozzi and Brad Smith break down the top headlines from Airbnb's commentary. Now, personally, what I'm watching for from Airbnb is the outlook for demand. The likes of Hilton, Royal Caribbean, and of course, a lot of these travel operators saw a strong outlook leading to the stock gaining after these reports. And now most analysts are pretty bullish that Airbnb could follow suit. There are, however, some wrinkles in the sheets for Airbnb that could prevent them from seeing gains. A few things to keep an eye on, or if you're listening to the call, an ear on, include the company seeing a potential slowdown in bookings. We saw that mentioned in November, as well as an adverse impact from a strong dollar. They do have a lot of international exposure. You also have the supply of rooms and homes, as rentals could see an impact since affordability is still an issue. You have rising interest rates, a lot of people not wanting to have that second home and rent it out as an Airbnb listing. And then, of course, those rising mortgage rates on the radar for Airbnb investors. All right, well, let's do a final check of the markets before we go. We see that all three are in negative territory. They're actually near their session lows as the sell-off continues into the noon hour. You see the Dow, they're off more than 350 points, down 1% on the day. The S&P, they're also losing ground, down about 0.8%. Their tech-heavy NASDAQ also down there 0.7%, losing about 84 points. Also want to take a look at what's trending in terms of tickers on the Yahoo Finance website at the moment. You see Palantir up at the top there. They reported their earnings, but that wasn't all that was causing excitement there. We saw that the CEO gave an update about some M&A action, possibly piquing investors' interest there, saying that obviously this is their first ever profitable quarter on a GAAP basis, but suggesting that the company could be attracting some possible acquirers. So of course, all that buzz helped send the stock up. You see there, up there, about 13% on the day. Also taking a look at Avis Budget there, up almost 6% on the day. Coca-Cola, a bit of a gauge there on perhaps how consumers are feeling, what they're willing to spend on. We did also mention some of those high orange prices that Alexandra Semenova mentioned there when we talk about some of the commodities that could be biting into Coca-Cola. Marriott reporting there, also giving us an idea of what's been happening in the travel sector. And chipmaker Nvidia there, up about 3% on the day. Well, that'll do it for now. I'm Rochelle Akutho. I'll be back at 11 a.m. Eastern. I'll see you then.